Here. Good morning here. Controller's Office.
Present.
Public Advocate's Office.
Here.
Borough President Manhattan.
Here.
Borough President Brooklyn.
Here.
Borough President Queens.
Here.
Borough President Staten Island.
Present.
Borough President Bronx.
Here.
International Brotherhood of Teamsters. Here. Transport Workers Union.
Here.
District Council 37.
Here.
We have a forum.
Great. Larry, over to you.
Let me hand it over to Martin. Getting seated, talk about the quarter. We'll be a little brief on the quarter since we're long past the quarter. And all of the interesting stuff happened in May and is happening in June. But we'll go through the quarterly report first. We have a reasonably long public agenda to get through. And then we have also a reasonably long executive session to get through. So over to you, Martin.
Anyone need any extra copies? I have one more to go. So as Larry mentioned, the March quarter, while we're almost a few days away from the end of the June quarter, the March quarter was very different from this quarter. Very strong equity returns in the U.S. were up about 12%. Equity returns everywhere were up because risk was back on, and as you see, high yield as well. And treasuries had negative return as investors sold treasuries. If you turn to page 7, we show the total return for NYCERS. On the left is the quarter, and the return was a very strong 8.01, primarily driven by the very strong equity returns in double digits. That was slightly behind the policy benchmark of 816. That brought the fiscal year to date and one-year numbers back into positive territory. The three-year number looks very high at 1719 on an absolute basis, while it's behind the policy benchmark. The returns are high because the bad quarter from 08 rolled off at that time, and that's why you see the five-year number go back down again. The next few pages are pages that we've shown, I believe, at last month's meeting with the asset allocations, and pages after that show the allocation and management effects. The allocation effects, the management effects, the allocation effect is over underweights causing you to outperform or underperform. The management effect is whether the managers did well or not versus their benchmarks. And the management effect summary is on page 14. Most of those come from private equity, and part of that is underperformance, and part of that is timing differences. As you know, those numbers lag. But part of the explanation...
What was the allocation? You said the allocation?
So for the quarter on page 11, it was actually positive because we were overweight equities. So for the quarter on page 11, you'll see if we were at, in the green bar in the middle, if we had been simply at each of the policies all throughout the quarter, we would have returned 754. In fact, we returned 801. Part of that is because of a positive allocation effect, because we were overweight equities and equities as well. And part of that is a negative management effect. Some of the managers underperform, and also the timing issues of private equity, which we've seen in rising markets, private equity lags, and in down markets, private equities bring the returns up.
Martin, what policy portfolio are you using for this?
The new, so if you go back, take a look.
And could you footnote it too, so we're all, when we look at it on our own, we can figure out what we're looking at?
So let me explain, and then I will certainly footnote it. If you turn back to page 10, it's the adjusted new policy, but it's also linked to the old policy. So presently, when the board adopted their new policy, we gradually moved into that new policy. That's incorporated into these allocation and management, actually the allocation effects. And prior to the new investment asset allocation last summer, it's linked to the old asset allocation. So there is a linkage between the old and the new. So when you look at the three-year number, it's linked the returns back then to the returns today. And if you take a look on page 15 and page 16, where we show the returns over and underweight, I actually want to turn to page 16 to explain part of the allocation effect, the negative allocation effect for 3 years. As I explained to you, the bad years rolled off, or the bad year rolled off, and you can see that on the left side of the page on on page 16, I'm sorry, the right side of the page, I have trouble with right and left, on this side of the page, you'll see that in March of '09, which was the year ending March of '09, which is pretty much the bottom of the market, there was a negative return, a fairly substantial negative return, and the plan outperformed because we were overweight fixed income. We were overweight fixed income in large part because the equity markets dropped, public equity markets dropped nearly 50% and dropped very, very fast. It wasn't to drop so quickly, it was very difficult to get the money back in. In '08 as well, we outperformed when it was roughly a flat market. And then the following year, in March 2010, for the year ending March 2010, because while we did put money back into the equity markets to get back to the edge of the rebalancing range for the equities, you couldn't shovel the money in fast enough. And so we were outperforming for the years '08 and '09, underperforming in the year 10, and the year '08 and '09 rolled off a 3-year number. And that's why when you look at the 5-year number, it's smoothed out when you go back to the returns versus the policy. As for the last year, if you go back to page 15, you'll see that the 1-year number of 425 places you in the 46th percentile. The policy benchmark was higher than that, and that's partially due to cash and the overweight to equity that hurt during part of the periods such as September of last year. When the market went down.
Let me ask you this, Martin, too. In our, and I guess this is directed to you too, Larry, and I guess everybody on the board, in our reallocation, are we figuring out what we can do to mitigate this situation that happened in
Yes, so,
2008?
right, so we are. We look at this at least once a week. I look at it actually more often than that. But the issue here was, back then, obviously, was a fast-moving market. The market's moving very fast now. Risk on, risk off. Right now, risk is off. And the places where we are, as you see, if you turn back, I believe, to page 10, which is the adjusted policy, and Larry will talk a little bit more when he talks about April, where we were overweight U.S. equity in green on the left and underweight 4+5. We've taken steps to increase or decrease the underweight to get 4+5 back into policy and to take U.S. equity down to bring that closer to policy as well. But Larry will go into that in a little bit more detail. The short answer is, in some cases, the markets move so fast, it's very difficult to react on a day-to-day basis to that, but we are working to get from the old policy to the new policy. As you know, opportunistic fixed income, it's going to take some time. Hedge funds will take some time. And so because of that, our policy mix for the adjusted policy purposes of the benchmark, we don't say that hedge funds are 5% or 3% or whatever the number is. We say it's the number until we get to the policy. And then we have the parking places. So we're not saying that from June of 11 you had a 0% hedge fund allocation, or May of 11 you had a 0% hedge fund allocation. In June of 11 you had a 5% allocation. You are now measured versus that 5% allocation because you couldn't possibly be there since you just adopted the policy. So we're slowly, on a policy basis, legging in to calculate versus the actual versus the policy.
If I might, the question now that I think you asked, I thought had two elements to it. One, why is the historical compared to your peers different? And then a question of why can't we be closer, if I heard you correctly. The first one is simply that we've had more, I believe, more domestic equity than the typical public fund. And so when equities are up, you're going to look good relative to your peers. And when the markets go down, you're not going to look so good. The second question about what you should have as an asset allocation is, I don't believe, answered by being like everybody else, but being what you want to be. And that may be like everybody else, but I think you've spent time over the last couple of years with the Chief Investment Officer and BAM thinking very much about what a good policy would look like, short-term and long-term. You have, to some extent, attempted to de-risk the portfolio. and that's not a bad thing. But I would be cautious not, whenever looking at these comparisons with other funds, not to interpret that what they've done is necessarily the right thing. You're always going to be different. The question is, are you doing what you're happy with? And I think you've been doing that. And so...
And our objective over time is to reduce the equity volatility in the portfolio.
And Callan does have similar performance attribution that we're prepared to discuss with you today if you'd like. In the interest of time, we may not, but we have a similar report that Martin's going through March.
Is that the quarterly report you did?
Yes.
Well, we should actually have it scheduled for every time you're ready to do it. We should look at it every quarter, absolutely, because that's where we make some of the adjustments for asset allocation, etc. Right?
Yeah.
So unless there are any other questions, I'm going to turn it over to Seema.
Thanks, Martin. If you turn to page 20 in your book, this is the domestic equity allocation and their results for the quarter. So as you can see in the pie chart, about 80% of the money is passive. And I'll just point you to a few columns: the index return, the actual return, and the difference column. And as you can see in the index return column, U.S. equities was up strong in the quarter. Mid-cap, if you scroll down a few rows, being the best of the group versus small cap and large cap at up 13.5%. But overall, the numbers were quite strong. And when you look at the difference column, there really aren't any, significant highlights to mention. The bottom row, the U.S. activists and environmental, it's a very small percentage of the allocation, and we've been slowly moving out of that particular allocation on the activist side, as you might remember, and we're majority out of that name in any case, so there's just a lot of leftover smaller numbers. If you turn to page 27.
I have a question. And this is just something curious. Why are we more active in mid-cap, and we're passive in mid-cap, and we have active large cap, and we also passive and active? You would think, intuitively, you'd want to be active in the mid-cap space. Is there somebody who can do some history on that?
I won't have as much history, but I can tell you in the time that I've been here that the board had elected to be more passive in general than active in the U.S. equities. And BAM did a large study while I was here where we showed over the last 30 plus years the return differential between small cap, mid cap, and large cap. And what we learned in that study was that mid-cap passive far outperformed large cap and even outperformed small cap during that long period of time, particularly since the year 2000 to now. And so...
But I'd be more interested in mid-cap passive versus mid-cap active.
Right, I'm getting to that. So BAM believes that the board should consider doing a reallocation in U.S. equities out of large cap into more mid cap and small cap. And then within each of those buckets, we looked at active versus passive and the split there. And BAM recommended, along with working with Callan, that we would be far more passive than active in large cap. We would be more passive than active in mid cap. And we would be more active than passive in small cap. And at the time, again, the board was more comfortable with a mid-cap allocation, but wanted it to be all passive and not focus on active management in mid-cap. And there was a mid-cap active search done before I got here. So again, that's the history part that I'm not as familiar with.
I can tell you, David, that over the, indexing moves in and out of favor just like other styles, but over the last 5 years, the S&P 400, the mid-cap index, has been top quartile versus active management.
Okay, so if you turn to page 27, it's the international allocation for NYCERS. And as you can see here, the active portion of the international allocation is much larger than the passive portion, which is different than in U.S. equities. And again, I'll just point you to a couple columns, the index return, the actual return, and the difference column. In the index return column, you can see some very strong numbers in the quarter, but that's the March quarter. So IFA up over 10%, and then emerging markets was very strong at up over 14%. And just a couple highlights in the difference column. These are small pieces of the overall allocation, but in the non-U.S. activist, you had very strong outperformance, and that's one of your manager's governance for owners. And then lastly, if you turn to page 36, again, it's very early days in the hedge fund program, but we've got a slide there now in the book on page 36 that shows you fiscal year to date, which we did start with the Kamal portfolio in smaller portions. We funded the entire allocation, you might remember, in Kamal by August. So we started in July, so that's why we do have a fiscal year-to-date number. And again, early days, but the portfolio is outperforming the composite hedge fund index, plus the 1%, which is one of our benchmarks. And now I'll turn it back to Martin.
Thank you. If you turn to page 38, that shows a summary of where your fixed income assets were allocated as of March 31st. The total was 27% of the assets, or over $11.5 billion. As shown in the chart, the largest portion, 55%, was in your investment grade fixed income program. Breaking that down further, on page 39, you see that over 15% of the fund was invested there, or over $6 billion. And the chart below shows that we were underweight the treasury sector and overweight the spread sectors, mortgages, and credit. Because risk was back on in that quarter, Treasury in the index and actual return showed negative numbers, some of the only negative numbers you'll see here, and the other sectors showed modest positive numbers. The good news is, in the difference column, each of the sectors outperformed, and of the 13 managers that we employ across the systems, 12 actually outperformed, so we're pleased about that. The actual results are shown on page 40. And while SEMA's results were, on an absolute basis, were very good, I can't compete with that. Nevertheless, the returns were positive at 1.01 versus a 38 basis point return for the benchmark for the quarter. Fiscal year to date is 8 basis points behind, returning 648, and the 1-month number as well as the 3-year number are very strong as interest rates continue to rally with results over 9%. And I do want to point out on the bottom, and I've tended to point this out before, but I do want to point out again, if you look at the 3-year standard deviation, we're now in the low 3% range, so you achieved your over 9.5% return with a little over 3% volatility. Interest rate volatility has been actually decreasing considerably, as I'll show you on the next page, and that's partly because of the Fed's telegraphing of what their actions are going to be. On page 41, you see the TIPS number. It's about $1 billion, and we underperformed by 6 basis points, returning a positive 80 basis points. Fiscal year to date, returning 859, and the 1-year number very strong, double digits, 1231. But also looking at the bottom, you'll see that the standard deviation or volatility of returns have definitely dropped, and that's TIPS are government treasuries, a form of government treasuries, and that's a big part of why the volatility has gone down, because treasuries, interest rate volatility has decreased. High yield is on page 42. It's 6% of the fund, and you'll see very strong 3-year numbers. And even when the, unlike equities, where you have slight positive numbers for the 5-year number, the 5-year number for high yield actually is a very strong 785, also ahead of the benchmark. But for the quarter, risk was back on, returning 476, just ahead of the benchmark, bringing the fiscal year and 12-month numbers back into stronger positive territory. Equities do have a fairly strong correlation. Enhanced yield, high yield has a fairly strong correlation to equities. Convertible bonds on the next page has even a stronger correlation. That's why the returns on an absolute basis are even stronger. For the quarter, 788, they were behind the benchmark, and we will be discussing that a bit in the executive session. Sure. Convertible bonds were strong on an absolute basis, returning 788, but were behind the benchmark for the quarter, and we will be discussing that in executive session. But it did bring the fiscal year to date to a positive number. Although low, it's still a positive number, and the 12-month number is still slightly negative. The 3-year number, as you see, is 1608. If we were to take out the number since inception, which is June of '08, the return would be much closer to the benchmark, but still slightly behind, and again, we'll talk about that in executive session. And my last comment is on opportunistic fixed income on page 44. We're at an inflection point in the program. Some of the older funds that we were in that had lockup terms, traditional funds that you go in with other investors, are rolling off the portfolio. And rolling into the portfolio are the strategic mandates that we're contracting with managers that were approved by the board. And so you're going to start seeing some of those numbers being reflected. But the numbers here reflected effectively those older funds that we went into, such as PIMCO Disco, which closed during the return to all capital during the March quarter. Any questions before I
Is that's why you're saying we're under the benchmark on the periods that you show, except for the 3 months?
No. What I would say is part of this is technical. It gets into IRRs versus time-weighted rates of return. Remember, the benchmark is also in the IPS a 10% flat. So for the 3-year number, obviously it beat that. For the 1-year number, it was behind. Part of the issue with time-weighted rates of return versus IRRs, and this is an issue with private equity and real estate as well, a time-weighted rate of return says, how much money do you have today? What's the value today? What was the value yesterday? Divide today by yesterday, that's your return, minus any cash flows. The problem is when we have some smaller accounts, as they've been drawing down and winding down, the market values are actually very small. So if you have, let's say, $500,000 left in an account with a few securities left, and they write that, and the reason those securities are left is because those are the few that they couldn't sell and they're working to sell, and let's say they didn't sell for a 50% loss, you have a 50% loss off of a very small base, but on a time-weighted basis, it's still a 50% loss that has to go across and can actually distort what the IRR would then show as a positive number. The reality is the IRR is more reflective of what happened. Money in, money out. How much money did you put in? How much money did you take out? Whereas, using an extreme case, if you had an account that was worth 10 cents and it was written down to 5 cents, you have a 50% loss.
Okay.
And that would show up. So this is based on some small numbers on some of the funds that we're rolling off.
So how do we tell what's really happening?
We're going to have, in our annual review next month, we'll be describing in more detail each of the funds.
Yeah, because I mean, if I understand what you're saying, then this chart is
Over time, it evens out. So that's why the 3-year number evens out. But in shorter periods of time, you can have discrepancies between the time-weighted rate of return and the IRRs.
You'll get a better snapshot next month.
Right.
Fund.
You'll see it.
You'll feel much better about
I
it.
think my point is that for public consumption,
Yeah.
which is what this is that it's not telling the whole story.
These are the time-weighted rates of return, but like private equity and real estate, the IRRs are also provided. They're just not provided here. So I do agree with you that on a consistency basis, we show the time-weighted rates of return for all the asset classes. But we're going to report to you next month to show you IRRs. And actually, in this book, when Larry goes through it, it'll show the IRRs.
Okay.
And now I'll turn it over to Ken.
Okay, for ETI returns on page 47. Good morning. I'll remind you that your returns are shown net of fees for ETIs, which average in the mid-30s, and while they underperformed for fiscal year to date and 12 months, the portfolio is basically stable and outperformed for all longer periods. I'll turn your attention briefly to the large agenda package, page 7. There you can see a breakdown of where your investments impact the boroughs of New York City. I'll just say one highlight on the first page, which is that you committed $10 million in the last quarter for new projects and purchased about $9 million in loans for about 600 units of, how many units are right? Let's see what these glasses. Almost 300 units of.
Kathy, can I ask in the future, maybe larger height?
Yeah, I've been working on that. Or I'll bring a magnifying glass, one or the other.
I think I'll bring it out.
That's on the screen?
Yeah, I've been working on that. It's hard to get this all on one page. But you can see the current commitments.
If I look real close, yes.
Yeah.
Kathy, I think the answer to this page is we should have it in more pages.
More pages, I can do that, absolutely.
That'll make it type
Which
bigger.
column am I looking at?
The chart's on a separate page.
The chart on the right shows you your current commitments. Yeah, I realize I can't even read it with my glasses. Julie knows.
Thank you, Kathy.
Okay.
So now we're going to do private equity. If people want to take a look in the monthly book on page 58.
It's a lot of paper going down there.
It's the thinner color book, page 58. So color book.
The recycling contract.
Oh, yeah.
There's another small chart for everyone.
Add extra books if anyone gets them.
Yeah, right there.
Okay, so on page 58, here we go over the monthly cash flow for private equity. So this is dollars in, dollars out, forgetting about IRRs, forgetting about time weighted. This is kind of showing you what the portfolio is doing. So again, we're doing a quarterly report as of 12/31. So you'll see in November, in that quarter, that was the only month the portfolio generated positive returns. When I say positive returns, again, we're talking about cash. So it's distributions coming out. The best way to look at this chart is look at the green, which is a little dot. If the green is above the line, that means distributions outpace contributions. If the green triangle is below the line, contributions outpace distributions. So if you look at in the quarter end 12/31, the month of November generated positive distributions. If you roll forward to today, so April was again a positive month, but we've been running negative so contributions outpacing distributions for most of the first quarter. Much of this has to do with the decrease in distributions for overall private equity, as well as some new commitments the retirement system has made. As of the fourth quarter, there were 3 new commitments made by the retirement system: Green Equity, Vista, and American Securities, which aggregated roughly $300 million in commitments. And if you look at the overall returns, so the one-year returns as of 12/31, retirement system generated returns of 8.1%, which was ahead of the policy benchmark, which was 6.6%, and ahead of the Thompson one, the kind of the median IRR benchmark, which was 3%. Again, this is as of December, so if there are any questions, happy to discuss.
Barry, how would you characterize the rate of realizations for this last fiscal year? Would you say it was more or less than the average of prior years? Because it seems to me that it's a lot less, right?
Well, it's a little bit of it's a misnomer when doing that comparison, because as we increase the pace in commitments, you really have to look at more of as a percentage as opposed to actual dollars. So even if your actual dollars are up, you've actually made larger commitments to private equity. So what I would say in very general terms is that the level of distributions has decreased. The level of distribution has decreased both in the retirement system as well as in the industry in general.
Yeah.
There was a window of when the public markets were open for private equity managers to exit through the IPO market. That happened, but the window was, like any window, was a small window. So there have been some sales to strategics, but if you look, and actually this chart really shows it well, if you look at kind of the end of year 12/11 and where we are for most of the month, there have been significant amounts of contributions. So again, there's more money going out the door than's coming in. And that's probably the trend until the public equity market starts to stabilize. If you look at what's been happening in distribution pace, it's been slow.
Okay, in the same book, let's talk about the real estate portfolio. So the following page, if you go to page 60, you'll see a similar graph on the activity of the real estate portfolio, contributions going out, distributions coming in. I'd like to say that the real estate program is less mature than the private equity portfolio. And so in terms of tracking that green line, you'll see that that green line is consistently below zero, or that you're in a net negative cash flow position where we are funding our managers. Our managers are putting that money to work. They are harvesting the portfolio, but have yet to monetize some of their investments. And when you see those monetizations, you'll see those little light blue spikes above the zero line, but we'll probably see more of that 2-3 years down the road. But for the near term, they are, as you can see toward the right, that there's definitely money going out. If we kind of take a look at April specifically, there was $73 million going out. The managers are now comfortable enough to make transactions in the market. In fact, transaction volume in real estate has increased 50% over the year before. So although the recovery in real estate has been slow and gradual, we've lost momentum here and there, as Barry commented, consistent with what the disruption in the public market. However, we do have about 27 managers out there trying to put your money to work. We have 40 investments at this particular point. In terms of performance in the near term, for the fourth quarter 2011, the NYCERS portfolio performed at 5.7%, which was 300 basis points above its benchmark, which is the Odyssey Net. If you kind of look over the 12-month period, again, superior performance at 17.7% for the year compared to the Odyssey Net on 15%. On a longer-term basis, the portfolio since inception is sitting right on top of the benchmark. So that would conclude my comments on real estate.
All right, going back, Barry, the chart on 58, does that include proceeds from the secondary sales or not?
So, depending on which month you're looking at, so if you look at April of 12, that would include proceeds from the, what we'll call, for lack of a better term, the first tranche.
Okay.
Second, the balance hasn't closed yet.
The second tranche hasn't closed and the third tranche hasn't closed.
Yeah, that's the only tranche is closed, the first tranche.
We should probably color it a little so that you don't somehow,
We'll work on it.
yeah, or maybe exclude it because it's a one-shot deal. It doesn't really get into the real flows of the investments and the exit realizations.
Okay, we'll do something. We'll figure it out.
Thank you.
So that's the quarter. Let's all look in this book now, monthly. So I guess just by way of introduction, what we're going to find in the first calendar quarter versus the second calendar quarter is a tale of two very, very different quarters. So the first quarter was a very good quarter. It was good because there was relief coming out of Europe in December from the ECB. So the equity markets rallied a lot, if you may recall. The second quarter is nowhere near as good. In fact, it's something of a mess. So these are the April numbers, and we'll walk a little bit through them. But really, the most important thing is in the April numbers, it's the May numbers. We don't have the May numbers. Okay, so again, we can go through April. I'll give you a quick primer on April. But May is the problem. We're muddling around in June. You know, we got 4 more days left, or 3 more days left in the fiscal year, so we'll see where we end up. What happened in the second quarter, and it started in April, was you had the French elections. They selected a new president. And the reality of the new president, Holland, was he's pro-growth versus Sarkozy, who was arm in arm with Merkel, being pro-austerity. So these are the two countries that are sort of leading what's going on in Europe and the Euro, and all of a sudden there was a change of partners. So it's kind of like a new pitcher shows up. While that was going on, the Greeks, who have been the biggest problem, had an election, and that was inconclusive and led to sort of 6 or 7 weeks of all sorts of turmoil because The incumbent was threatened by the socialists, who basically wanted to step away from the deal that they'd made with the Europeans, and that caused all sorts of havoc. It's the simplest way to put it. So, and that happened April, May, into June, into last week. At the same time, because of all this uncertainty that's gone on in Europe, the economies are slowly drifting into recession, and no one can do very much about that. It's had, as you might imagine, a ripple effect back to the United States. So the U.S. economy has slowed down. So what was trying to be 2.5% to 3% growth turned out to be 1.9% growth in the first quarter, which was again reported in the second quarter. Unemployment's ticked up to 8.3%. And then, of course, if those two economies are going down, China is slowing. China has its own set of issues, but China is slowing. So all that, having had a really good quarter in March, meant all sorts of noise and volatility back in the markets, primarily in May and falling into June. The reaction to that has been the Fed has sort of last week announced Operation Twist 2, which is really their approach, although it's only for the rest of the year, to keep rates low and extend and do as much as they can do short of fiscal policy, which is really not their job. And again, the longer-term backdrop is we've got this presidential election, so we have uncertainty. So you have uncertainty in Europe, you have all the economies basically slowing down, and you have no resolution until, at least in the United States, until the election, then you have the fiscal cliff in December. So, very difficult to make money in a market where people are reacting to nothing that looks like intrinsic values or PE multiples or relevant yields. It's all based on what everyone reads in the newspapers, or guesses in the newspapers, or makes bets on who wins elections. So we're just in for a period of heightened volatility, and we'll sort of play through with our asset allocation and with our managers, but it's just going to, on a month-to-month basis, it's pretty, I wouldn't say frustrating, it just is what it is, but we're going to go through, and because we lag, you're just going to see it slower than you'd like, but I'll try to update you as much as I can. So the easiest place to sort of get a quick read on what I just said. And by the way, the leading indicators aren't very good either, just to depress you some more. The leading indicators are down. So consumer confidence is waning. Architectural billings, which you all know I look at a lot, is down. So I would tell you that we're you know, I wouldn't say we're going back to a recession, but again, the economy's slowing, and in the U.S. in particular, as well as in Europe, and until politics settles down and the euro uncertainty goes away, which my guess is it won't for a while, you're just going to have very volatile, difficult markets. So the easiest place to sort of get a handle on this, not easiest, I would turn you to page 24, just as a backdrop. So 24 is the Treasury yield curve. And again, in my mind at least, the people that have been the most constructive have been the U.S. Fed. And they have diligently said, we're keeping rates low, and we're going to keep taking them low, and we're going to do the damnedest to keep things down. So if you look at the white line, they have been very, very successful at keeping rates low and extended the low rates into 1 year, 2 years, 3 years. You know, the 10-year rate during part of the volatility in May hit like 1.45%, which I would tell you is a pretty ridiculous rate for a 10-year loan.
Excuse me, Larry, I was just thinking that perhaps in the future we should use a white line.
No, what happened this time was the background, I apologize, this was my fault. The background normally we have is blue, so the white shows up. It turned out it turned out to be less blue.
Mine's very good.
See, Larry has the blue version. The blue turned out to be less blue. So,
Let me describe to you what the white line looks like.
Let this be the most trouble our trustees have today with math.
So the white line, which is the current yield curve, is below every other line. That's sort of the punchline. And again, the Fed's working on that. The Fed is saying everything it can and is sort of doing the right things. But again, they're just one of the players in the game, with some of the players being unable to play the game. Perhaps you can see it better on page 25, which is a 10-year rate. And again, if you look at it, the second set of dots from the right is the beginning of the year, and all it's done basically is gone down, right? Which again, it's good for the economy. In theory, it's good for the economy, but it's a lot more complicated than that. That said, you can see on page 31, and again, I apologize for people that have trouble reading this, but if you go 1, 2, 3, 4, 3 hash mark lines from the right, you'll see the April numbers, which again, if you move your fingers in to the right, you'll see they go down a lot. That's May. You don't have the May numbers. I'll give you a preview of what May looks like, but these numbers are about to go through quickly, and I'll stop talking, are before something bad went on, is the simplest way to put it. So if you look at page 33, despite all the volatility that went on in the fall, corrected by things that happened well in the spring, we ended April at about $41.8 billion. So again, just to try to get some context here, if you go to page 41, the numbers on the far left are the 1-month numbers of April. So again, the first block up top is the U.S. stock market. The U.S. stock market was down roughly 1%. International markets were down 1 to 2%. Bond markets are up 1 to 2%. That's all good. And just so you don't get too comfortable on good, the next page, 42, is the problem. 42 is May. 42 is the result of the French elections, the Greek problem, a few other problems that cropped up, but lots of people trying to take profits out of the beginning. So what happened in May, U.S. stock market tanked. It was down 6%. EFA was down 11.5%. Emerging markets was down 11%. The Treasury market went ahead to sort of risk off, and the high yield market backed up. So these numbers aren't in here, the effect on the portfolio. But I'll tell you our estimates. So if you go back to page 33 for a second, just to put the whole thing in context. If you write down next to the 41.8 billion, 39 billion, we were down about 6% in May, and we're up to about 40 billion now in June. But again, June is one of these very, very volatile months because what's happened subsequent to the May conversation was Spain decided they needed 100 billion euro for their banks. So nothing good is going on in Europe, and it's coming back to the United States into uncertainty, and uncertainty means people don't invest and people don't hire, and we're just going to have a bad rest of the year. So again, as an estimate, we're at about $40 billion. Again, the U.S. market was down over 1% yesterday. It's up a little today, so we only have 3 days left for the rest of the fiscal year. So again, we came into the year at 41.8. I'm not quite sure we're going to get back to 41.8 unless the market rallies in the next 3 days. So I think we'll be down a little bit. But again, I can't quite tell you because my crystal ball is completely cloudy.
Sounds pretty clear to me.
So that all said, if you go to page 37, back to our asset allocation, again, this is a snapshot, and I need to give you some new numbers around the snapshot because it's old. So coming out of the first quarter, when equities rallied, we were over-allocated U.S. equities, which we then took down in May and June. And we're under-allocated in 4+5, which we took up in May and June. Actually, May, not June. So again, if you just jot these numbers down, I'm going to give you a preview, because again, these numbers are behind, but I want to make sure people are close to what we're doing. So U.S. equities are down 3% from here, so we're back in the bands at about 2.3% overweighted. Core plus 5, we added a little less than 2%, so we're right at the edge of being back in bounds. And we're going to talk about a Core plus 5 investment later today, so we'll be in bounds. We took down EFA a little bit, so we're spot on the asset allocation. EFA, we funded some hedge funds that we approved last month, and opportunistic fixed income is coming up as the documents get sorted out and the managers basically become live with what we've agreed to, and we paid some benefits. So all in all, we rebalanced pretty substantially from the overweightings that happened as a result of the markets going up in March and pretty much a little bit of April. So we're pretty much back in range everywhere, except for a little under. Well, actually, we're back in range virtually everywhere, having rebalanced one last time before the end of the fiscal year. Again, I'd show you the new numbers, but we don't quite have them quite yet, so you have to. Next month, we're going to try to have an estimate for the fiscal year end, because I think is it the third week that we get together in June? Third week? In July? Yeah, 22nd. So we should have a pretty good estimate as to where we are at the end of the fiscal year, both on an asset allocation basis as well as in a return basis. But again, there's only there's only 4 trading days left in the year, so it's difficult to see how we're going to be positive for the year. I think we'll be down a little bit. But I actually think we might be about down as much as we net paid out in benefits, so it could be sort of a push on an investment basis. But again, the markets are bouncing around so much it's hard to put a pin in what the number is, but it might just be close to a break-even year. While we moved everything, again, we had the asset reallocation in July, I think it was July, the parking places, and again, we're executing the plan that we all agreed to. So that's April, but again, April is completely overwhelmed by May and this stuff is June. So I hope that didn't depress you too much. I did? Oh, sorry. I'd say the bar's open, but it's too early. 5 o'clock something. So that is what, I mean, again.
So Kellen has their quarterly report, and I think our trustees agree in agreement that we should spend some time with it. Thank you.
Madam Chair, while that's being passed around, just to clarify something, we're not meeting in August this summer?
It's not on the calendar now.
Sorry? I know we usually don't, but I know sometimes we're not.
Well, not last year we might have.
Because last year we did. Last year we were.
So as of now, nothing on the calendar.
Okay, thank you. Because I had no deposit.
Pardon me?
Online.
Yeah, you keep women track. Right over to you.
Okay, great, thank you. So this is a similar report that we covered last quarter, showing how the total fund and your broad public markets have done versus their benchmarks. And if you turn to page 2, this is taking a snapshot look at the asset allocation as of March 31 versus the new long-term target that was established last year. When you look at the broad asset classes, as Martin and Larry pointed out before me, domestic equity, international equity are above the long-term target for the quarter. Structured fixed income is below. High yield is above. Real estate is below. Hedge funds is below. And private equity is above. That's versus the 2 pie charts there, actual versus target. To the right of the page, it shows how your various allocations to the asset classes compare to other public funds in the Callan database. And so your 40% allocated to domestic equity is above the median against peers. The target at 32.6 is actually a little bit below. That would be something that we would be getting towards. And then you can see the various other asset classes as you go across. On page,
The target is what is the average of our peers? Or is that's...
the median is the sort of the median of the peers.
Okay.
The target is your actual long-term target.
Oh, I see. Okay.
The fund is where you are now, the actual as of March 31. And then the target is your long-term target.
So the median of our peers is around 38 and a half.
Right.
We were at 40 and change, but we're headed to 32.6.
Correct. And then on page 3...
Hold on a second.
Yes.
I'm trying to put this in some context, because it just shows us relative to peers, whatever, we define as a peer. But it doesn't really tell me, how this, how performance is affected by this relative to our peers. This is just...
Correct, just wait.
Just waiting.
Yeah, this is just weighting where you are versus your targets and where you are versus peers as of March 31. We haven't gotten into performance yet.
But what does it mean that, it's just a marker for us?
Yeah, it's just to show you in comparison to your peer group how you look. It's not to make an opinion one way or the other.
Well, it begins in a way because it goes back to Bob North's point, right?
That's what I was-
Yeah, which is, in any given time period, when you look at our performance in that Tux universe, what you're really just seeing most of the time in short time periods is beta differences. You're just seeing someone has 45% equities versus our 40.
Sure.
So this is actually helpful to understand that relative to our peer group, we have no international fixed income in a period that really helps. For example, that might be the reason for our relative performance.
Right, I was just saying that I'm not making an opinion on you should be above or below the median.
What I find interesting about a chart like this is if you look at the domestic equity, I'm not quoting you. When you say peers, is this greater than 10 billion?
No, this one captures more because there's more players. This is all the public funds in the database.
Oh, so little guys,
Regardless of size.
Yeah, in this comparison, it is the full.
Can you change that to be?
We could. It's just that there's not as many members in the above 10 billion.
Well, I would almost go to another level. I'm almost wondering if there are 20 plans that we would benchmark ourselves to that have somewhere between 25 and 60 million that have the right. Because not only is it asset allocation, you also need to adjust for governance. There are lots of things to make this truly meaningful, you would adjust for. So I don't know, Larry, if you want to work.
well, what I was about to say is what's not on here, which overwhelms everything, is what their liabilities are. Right? So if you see something like U.S. equities that go from 20 to 50%, they're trying to tell you something, right? They're funding, they're taking a certain amount of risk, they've got an asset allocation, but until you understand what they're trying to fund, the whole thing it's interesting, but it's really only half the pie. So, I mean, again, if you take a fully funded plan, they're going to just have a completely different asset allocation than someone who's 50% funded. None of that comes across in one of these. So it's interesting, but it's just that.
So I think again, if you had a more robust peer group, then we could actually look at their funded status relative to ours, right?
I
That
think
makes
you
some
need to have
sense
that.
of it. But again, we know Callan is just starting something that's just a dialogue we've never had, so this is just
Right.
all good.
Okay,
Well, what would you,
I'm thinking like
10 billion.
well, I think even 10 billion is too broad, right? And so are there 20 plans, because that becomes statistically meaningful, that we would benchmark ourselves to, whether it's between...
the 20 plans with the highest?
Yeah, and I don't think it should be between 25 and 60, because our costs are based on a 120 billion pool. So we have a little... So I'm almost leaving it to Callan to come back and say, how do you look at a more robust peer group? And let's cut for a couple of things. Let's cut for scale, let's cut for funded status, to Larry's point. Let's just understand what that group of 20 looks like first before we adopt it as our peer group.
Okay. Turning to page...
Make sense, Al?
Turning to page 3, this is the comparison of your actual asset allocation, which is the same pie chart as on page 2, versus your interim target. And I'll get into how we developed your interim target. Basically, at September 30th, when we started doing this analysis, we took a look at where you were versus your new long-term target. And if you were severely underfunded in those asset classes, like real estate, opportunistic fixed, and hedge funds, then we created a different benchmark for that asset class because we realized it was going to take some time to get allocated to that asset class. So if you look at the description of the interim benchmark, you'll see that it's the same for broad domestic equity, 32.6, Russell 3000. We left it the same as your long-term target. For global ex-US equity, it's the same, 16.9% all-country world index ex-US. And the fixed income allocation is the same at 20% core plus 5. Same holds true for TIPS, for high yield, and for private equity. All those asset classes were basically fully funded as of September 30th of 2011. If you look at the next group of asset classes, starting with real estate, at September 30th, 2011, you had a 3.7% allocation to real estate. So we said, okay, let's make, for that portion of it, 3.7% will make the benchmark what the long-term benchmark is, which is the NFI ODCE real estate benchmark. And then for the difference between the long-term, which is 6% for real estate, and that 3.7, we go back to that memo that was discussed back in the summertime about where are we going to pull assets from, where are the parking places for the various asset classes. And in the case of real estate, we said that half of it would come from domestic equity and the other half to come from the core plus 5. So the difference between your long-term target of 6% and where you were at September 30th of 3.7 is 2.3%, and that's split evenly 50-50 between the Russell 3000 index and the core plus 5 index.
So, but I think what might matter the most to the board is to be consistent with them. And I don't know there are differences because, and there must be differences because you're showing a different target benchmark return than BAM showed. They showed 754, and no matter how you all cut it, the numbers are not the same. So, and it's only for one quarter, so I would assume that there's no noise here.
Yeah, I have to admit that Martin and I and Larry and I haven't discussed where their benchmark is versus
I think
where
very
ours is.
important to, because we just should see one attribution.
I assume the parking places are the same, but...
Rules are the rules.
Right, the rules are the rules. So we'll check it out.
Okay. And so that's how we developed the interim, where we were as of September 30, 2011, and then the parking places make up the difference. And then that section to the right where it says or, we just took all the common benchmarks and added them up to create the interim target. Okay, starting on page 4, we have a number of different attribution analysis here, which is a little bit more robust than the last time because of the discussion of private equity and how you handle that because it's on the quarter lag. And so here we're looking at the total fund versus the new long-term target, so not the interim, just the long-term target. And we held the private equity return equal to itself. Because of the differences between the lag, we just said, well, the private equity return at NYCERS equals what the benchmark would be. And here you're seeing that the actual return of 801 ahead of the target return of 717, and the components are 33 basis points of manager effect, which is the manager's adding value, and 51 basis points of the style effect, or being the asset allocation effect, being different from the long-term target. And most of that is in the fact that you are overweight domestic equity, underweight structured fixed, when equity markets did very well. Page 5 is the same analysis, but now take a look at the total fund performance versus that interim target, and leaving the private equity return equal to itself. And there you see that it's the interim target is slightly higher than what the long-term target is by 3 basis points, so similar relative performance. What we do on page 6 and 7 is take a look at the total fund, but on page 6, it's against the new long-term target, but with private equity on a 1-quarter lag. So it's the Russell 3000 plus 5%, but brought back 1 quarter. And there, it creates a manager effect of negative 63 basis points. Page 7 is against the interim target with private equity at the 1-quarter lag. Similar with manager effect being 70 basis points negative. Then on the next few pages, we're taking a look at the 6-month return. So since we started the clock on September 30th, 2011. And page 8 is against the long-term target with private equity equal to itself. And the actual return is ahead of the target return. Manager effect is 29 basis points. The asset allocation effect is positive 48 basis points. Page 9 is the total fund over 6 months with private equity versus the interim target with private equity equal to itself. And similar, just that the target return is a little bit higher than the long-term target. And then on page 10 and 11, it is the 6-month performance with private equity. Page 10 is against the long-term target with private equity on a 1-quarter lag. There it is positive. So over the 6 months, even with the private equity against a benchmark, it is positive over this time period. And then page 11 is against the interim target with private equity on a 1-quarter lag. And again, positive for both the manager and the style.
I'm sorry, can you explain again what the focus of the 1-quarter lag analysis is?
Yes, because the actual returns that we're getting on the private equity portfolios are really not for this past quarter. We don't know what the most recent quarter is until next quarter. So the private equity numbers that are in here are really only up through December 31.
Okay, so you're just taking the benchmark and adding the 500 basis points.
Taking the benchmark for the prior quarter,
right,
to be in line with where we are with private equity. Okay, and then after that, we then look at the peer group comparisons, starting on page 12. Page 12, the top and bottom does not show what the target as far as the number goes, but you can sort of decipher that by looking to the left axis. On a relative basis, now this is versus the Callan 10 billion and above peer group, so it's a little more apples to apples. And the last year, ending March 31, you ranked in the 63rd percentile. The longer-term numbers are better. 2-year 36, 3-year 30, 17, 21 as you go across.
But if we have been at target, we would have been in the 16th percentile. Is that what you're saying?
Yes, you would have been the 16th percentile.
Or said another way, if we were 100% indexed
At the target weights.
at the target weights. So this is actually important point. Our active management is not adding value.
Now,
And it's
what,
where, as a board, we spend all of our time. That
Well,
I mean,
wait a minute, maybe I'm misunderstanding, but I thought the target, the policy target is the allocation targets that we haven't reached yet, right?
yes, these are the long-term targets linked to what the actuals were prior to September 30th.
Correct.
So in some cases, there is the fact that you haven't reached those targets, the most recent period, but prior to that is going by where you actually were.
And going by where we actually were for the last year, we would have been in 63% percentile, right?
Yes, your actual performance is that 63%. What you actually...
If in the last year, we had invested pursuant to our new target allocation,
That
we would have been at 16%.
16.
What is,
but it's both beta and active.
so what's
So
the
the
distinction
63
about, so I'm missing your distinction
Yeah.
about index versus active.
Yeah, but do you want to make it?
Yes. The 16 is just your index return at the target weight. It's not considering what active management would do.
Okay. All right.
So basically, this is telling you that your asset allocation targets were a very strong performer over these past periods. Well, that has to do with the long duration of your fixed income portfolio as interest rates have come down. And you
The
had,
policy target, sorry, is the policy target or the adjustment target you have?
on this page, it's the new long-term target as of September 30th, 2011, linked to your actual targets prior to that.
So it's something like real estate, where we're at 3,
Yeah.
it has it at 6.
It does, that's correct.
So look, let's see if we're doing good or bad.
You're doing very good against your peers. Over the last 3 years, you've trailed your benchmark. But over the last 4 years and 5 years, you're basically right on your benchmark, slightly below, and very good against your peers.
It's a work in progress.
Now, back to Ranji's point about the bottom of page 12 is an asset allocation adjusted ranking. So here we're saying, what if everybody in this database had the same asset allocation as NYCERS? And so this gets to the manager effect. And even so, throughout this period, your managers have added value versus peers, being above median in all time periods.
Well, does that mean they've added value, or they've added value only against their peers, who they all have lost money?
Yes. It is versus their peers.
We're in the upper 50%.
Yes.
Except for the last 5 years, we're in the upper quarter.
And then if you turn to page 13, we look at the performance. Here you can see a better view of your target return in actual numbers versus your actual return on a calendar year basis. And this is a similar chart to what Martin showed, although Martin's was for years ending March 31. Ours is actually calendar years.
So I think this was the question, Martin, I was asking, if I understand this. 2009, if we would have been at our new asset allocation, we would
No,
have
this
been-
is not the new asset. This was the asset allocation at that time.
Right.
No, the under 2009, the red number 2, that's the target allocation, right?
That is where we didn't start. The new target doesn't go in effect until September 30th, 2011. So what we're showing historically is your actual targets for that period of time.
Oh, I see.
So it's the difference between, to Al's question, and 2 in 2009, is the difference between number 2 and number 39 all the manager effect?
No, it's both.
I can tell you historically, a good part of it is this is when the equity, this is what I mentioned before, this is when the equity rally started and we rebalanced to the edge of the range, and so we were underweight equities at that time when you had a very strong equity rally.
Okay, so the target allocations are target allocations at that point in time.
Correct. And then, you know, to Bob's point, historically, for the 2008 76543, in every one of those years, you outperformed the index, which is a reflection of both asset allocation and manager effect. 2009 you underperformed, 10 you outperformed, 11 you underperformed, and year to date you outperformed.
Is there another way to express what you just said, Bob, which is prior to 2008, we actually didn't have a very good policy portfolio because it was consistently below median except for 2003. So we weren't, relative to this pure universe, our policy benchmark was in the bottom half, if not the bottom quartile.
That's correct. But again, you can't...
So a lot of this, in terms of how we spend our time, really keeps coming back to, are we picking the right policy portfolio? Because our returns relative to that is noise relative to the returns that come from the policy benchmarks and the beta. I keep making that point, but...
Right. But again, I think to Bob's point is that your specific asset allocation is specific to your needs.
Correct. But there's a very tight band. I mean, you can maybe, actually it isn't, it's very misleading because the scale is so cramped.
Yeah.
I can't tell if the range of returns is 10 percentage points or 2 percentage points.
Well, I guess if you look at the 10%
I guess if you look at the actual numbers, yeah.
Very, very tight.
Well, not really, Larry. 500 basis points, 600 basis points, 90th versus
What year are you looking
25th.
at?
Pardon me?
What year are you looking at?
All of them.
I'm looking at 11, 10.
Oh, no, I'm going back. I'm
300
just saying.
basis points from top to bottom.
Well, 300 basis points is a lot of money.
Every basis point is a lot.
Exactly. It's a lot. It sounds like a lot to me.
And moving on to the page 14 is taking a look at just your domestic equity portfolio in the aggregate. And here, the benchmark is the Russell 3000, 90% Russell 3000, 10% S&P 500 up until September 30th, and then linked to 100% Russell 3000 thereafter. And the performance shows that over the last year and 2 years, you have underperformed. Longer term, you've pretty much been spot on for the benchmarks. Page 15 shows the calendar year performance and some relative risk-adjusted measures. Page 16 is the international portfolio in the aggregate. And this benchmark is there's a couple of changes over time. It started with the MSCI EAFE index through June 30th, 2003. And then it was split between the EAFE index at 83% and the emerging market index at 17% up until 2006. Then MSCI EAFE and the FTSE Custom Benchmark through September 30th. And then, as of September 30th, it was the All Country World ex-US.
So when I looked on page 16 at the top right box, I mean, active has started to do better in recent periods, but my gosh, it was a real drain for a very long time relative. relatively
correct.
speaking. And if you look at all of these charts, it's just become a lot harder, it's become much more almost like a random walk here in terms of adding value from an active strategy. It's just become tougher and tougher. Managers either beat a lot or underperform a lot. It's very hard to make money here. Information ratios are poor to negative, or excess return ratios. So we are always focused as a board on returns, but we've got to start thinking more and more about risk-adjusted returns, and are we getting paid for the risks we are taking, and where do we take risks, and where are we getting paid? And David, to your mid-cap question, that was part of what drove BAM's recommendation to us, because in mid-cap, you just see wild numbers, and its question is, can we systematically make money from that, and it becomes very difficult.
And then on page 18, we begin the analysis of the total fixed income portfolio. And this, as you know, the fixed income includes not only the core plus 5, but it includes the TIPS, the opportunistic fixed income, and the high yield. And the opportunistic has not yet been fully funded. So you'll see as you go through the pages, there's the long-term target for fixed, and then there's an interim target that takes into account the fact that opportunistic has not been fully funded. On page 18, performance versus the long-term target. The last 2 years has trailed the benchmark. However, the 3-year number is ahead of the benchmark, and the 5 and the 10 are close but slightly below. And then versus peers, it's very strong, given the longer duration of the portfolio. Page 19 shows the calendar year performance, as well as the risk-adjusted measures. All the risk-adjusted measures look strong, too, in the top quartile. And then page 20 has the same portfolio against the interim fixed income target. And really where this comes into play is from September 30th on, because prior to September 30th we were utilizing what the fixed income benchmark was. Here it's a blend of the long-term target and the interim, creating the interim target, which shows a little bit better performance on a relative basis over the last quarter, similar but stronger over the last 3 years.
Questions for Callum? I guess my one request is that this make it into our board package, so we have time to actually review it before we come here. And that just means Callum has to get it to BAM within their deadline?
Yes.
If I may make a comment, one of the things that struck me going through the early parts of the presentation is the difference on attribution between what Callan shows and what the Bureau of Asset Management shows, which both partly do the lag effect on real estate and private equity, but also due to maybe some slightly different weightings, raises a question as to the real benefit of having short-term allocation analysis. Although I find it one of the most interesting things in the reports each month, it raises a question of just how valid is it, and whether or not Callan should both add something longer term to theirs and or at least caveat the natural volatility of things over the shorter term numbers.
So Bob, I thought the moment you went to pages 6 and 7, the numbers were much closer to BAM's because they did the 1 quarter lag, which is closer to BAM's numbers. BAM had 801, or 816 for the policy benchmark. But I think Larry took that as something they would work with Callan on, right? Anyway, just to
we'll
make
figure it
sure.
We should have one set of numbers.
Yeah, I think the key is just to get started. I think we all understand that short term, this is not as meaningful as it will be over time, but I don't think Callan can go back and retroactively calculate these, can you?
Well, they're already in our report. We could do the attribution, over a longer-term basis.
That's the only thing that matters to Bob's point. It's not quarter, it's
We
2
could
years.
show attribution over a longer-term basis.
Is that, Bob, so just 3 years would be more helpful, clearly, right?
Well, I just think the nature of things is that volatility is caused up and down of the markets and so forth, and individual managers have good quarters and bad quarters. And trying to attribute and believe that there's real value in short-term numbers on long-term investments, it's good to have the information, but having something that allows those natural short-term variances to be spread out or smoothed out, if they smooth out, I think is more useful. And I think this presentation was very helpful on that score in highlighting just how much of a difference there can be in how you just record the numbers, as well as the fact that they're short-term. I mean, the fact that a 1 quarter lag on private equity can swing the attribution by, what was it, almost a whole percentage point? Between
It's the single biggest contributor.
right, and between, for example, page 5 and page 7, I think those are the same period, but with private equity either valued as it was or with a 1 year lag, and it swings at almost 100 basis points for the entire portfolio, which, that raises a question of just how good and useful is 1 quarter at a time. So I'm a fan of having the information. I love numbers, but I think that the board should take great caution in terms of ascribing significant credibility to the shorter-term attribution and manager effect numbers.
So Bob, to your point, I sit on an investment committee where the shortest term number I've ever seen is a 1 year number, which I see once a year on fiscal year end, and we only see rolling 3 and 5 year numbers.
Need some transparency in that.
It's Bob's point. It's what we're there to do. It is not about quarterly fluctuations. You get mesmerized by them and think you can take risk on, risk off, and do these things which we can't do. It's not what we're here to do.
Yeah, I'm really glad that you raised that issue because they're long-term investments and you get too worked up over this short period of time if you concentrate on that being either very wonderful or very terrible. So I think your point is very good.
Well, it's particularly true, Pat, as we shift this asset allocation, we're moving more toward longer-term asset categories. So it's even compounding more than exactly what you said. We're supposed to be long-term investors. But if you think about where we increase our asset allocation is real estate, which takes a long time, private equity, which takes a long time, hedge funds, which should take a little while, and opportunistic fixed income, which is the same, takes a little while. So everything we're doing is making us more long-term. So I agree with you guys on the side of me says, I'm sorry we have these monthly numbers because, first of all, they're always out of date. And second of all, we are supposed to be thinking long-term, and as we move the asset allocation, because once we get there, we're going to get there. It's the monthly stuff is too complicated, particularly in this market, which is nothing to do with fundamentals at all. It's all politics.
But Larry, can we maybe go back to a flash report for a monthly, a one-pager, rather than all of this document,
Yeah,
which
I
doesn't
think we'll
mean
try.
anything? And then on the quarterly, maybe just do a high level and let Callan do their report and move us to more of a real drill down on a fiscal year-end basis where we have good data, catch up with the numbers, and then spend 2 hours rather than 45 minutes looking at stuff that's just so volatile every month.
We can do whatever the board wants to do.
Does something like that make sense to people, that we look at a monthly report, but it's a one-page flash report?
Well, I like,
Or leave it, well, this report can be there because Boney calculates it, we just don't have to go through it. We should go through our asset allocation, we should absolutely, but we don't have to, and Larry spends less and less time on it anyway, but
yeah, I think there's a lot, I mean, starting at page
the asset allocation we must do.
34.
We have it.
33.
We should have it, but I agree with Brian, he's walking through it all the time, just,
No, but I mean, just as a convenient form for me
Have it.
as a trustee.
We have it.
From 33 page on,
Policy,
page 33
yeah.
on, I would like to have this on a monthly basis. And then if there's one or two other, if there's something in here that,
Yeah, there's a chart you think we should look at, that's fine.
Yeah,
We don't need to do it.
maybe all these charts that we want to do monthly performing that we look at or don't look at.
I haven't referred, you notice I didn't refer to but one of those today.
Right.
They're there for everyone to look at.
Right, so maybe this stuff is an appendices, and the stuff I want to look at is, starts on page 33 through page 60.
David, we used to have a one-page summary flash report, and it was much more updated. For example, today would have been through last week or something like that. Much more useful than a monthly report that's, at this point, 2 months lag. And then we would do a quarterly, which is detail, and I'm saying over time, the calendar report should start to take the space of that, as long as Ben reconciles to Callan. And then the drill down should really be on an annual basis. And when we do it annually, we should look at all of our managers, not relative to the benchmark, but relative to their bogeys, because we hire some who are supposed to commit to doing benchmark plus 100, some who commit to benchmark plus 200. It should just be a much more robust report for us to understand what people are doing relative to what they committed to do. But we just can't spend all that time monthly, it's just, all of us are making the same point, it's just not useful. In fact, it leads to more decisions which can be bad for us, because we are reacting to short-term volatility.
Let's see what we can work on.
Okay.
Just work on it.
I think that what is presented monthly here in the monthly performance review, all that information is useful for digestion, but not spot analysis. And to the extent that Larry in his commentary every month often comes up with something that's very forward-looking as to the implications, that can be very, very useful to the board in setting big-picture policy questions. It's finding that balance between the overwhelming amount of short-term data and the long-term trends that makes this really hard.
So Larry's going to be hearing from us that we're open to
We'll work on
keep
it.
having the information, which is already in the big book, so we don't need a separate handout. All of that stuff is in our books, right? We get it ahead of time.
Yeah,
So it's just there, it's available.
I find it convenient, but I find this very convenient. From page 33 on, for me to be able to refer to something,
Right.
to talk to my principal, it's just been very useful. One other comment, to try. I don't know if it's possible, but starting on page 13, if there's some way you could include like a narrative of what the purpose of the chart is for us, because I'll be honest with you, I think I understand this, but I would like a little more help.
Okay.
So I'm talking about pages 13 through 21. If it's a sentence or two or whatever, the purpose of this chart is to show X.
Okay, no problem.
Okay.
Or actually, page 12, I'm sorry.
Okay,
Page 12.
it's in the monthly out.
No, this calendar report introduces it again. Sorry, page 12.
Okay, yeah, these are the plan. Thank you. Okay, do we have the real estate people here? Yes. Okay. So So we're going to bring in our real estate consultant, Townsend, and one of our managers to talk about Europe. As you know, we've agreed to a couple of funds that are global and mandated to invest some of their capital in the United States and some of it in Europe. So reacting to a request from the board to get educated a little more about what's going on here. We've got these guys coming in. I think you'll find it interesting. It all kind of leads to the same conclusion, which I guess is at the end. But it's interesting.
Okay. Good.
See what? Who's going to go first? Okay. So it's all yours.
Yes. Ready?
Sorry, if you can say your name and firm, and you must talk to the stenographer. She's the most important person in the room.
Okay, fine.
With all deference to my fellow trustees.
All right, my name is Jim Raylander. I'm with European Investors, and I'm here today to talk about the European markets as it relates to real estate and real estate investing. And we have a presentation, and if I can draw your attention to the first slide, and we'll go through this. And what I'll do is I've got a number of slides, but I'm going to talk through a lot of the information. I'll refer to a couple slides during the course of the presentation. Now, the first slide, you look at the headline, and this depends day to day, but when we put this together a few weeks ago, the macroeconomic trends in Europe are somewhat better than is advertised in the press. Now, it's, as I say, it's day to day. For example, we just got a data point from the Netherlands that GDP growth is actually better than had been expected, quite substantially better. And you'll get some that are as good, some bad. So it's sort of two steps forward, one step back. But in general, what you read in the press, I think, is a bit more depressing than what's actually happening on the ground. And a couple of key points that really are at the base of our view on the marketplace. We really don't believe that Greece will be drop-kicked out of the Eurozone. We think the costs are enormous. Just got a report today that's suggesting that if Germany decides they beat them in the European Championships and they're going to beat them again with not supporting them, it could cost Germany alone $1.2 trillion. And that's because the banks have a lot of debt throughout the area. Germany's economy is 45% dependent on exports. And, you're basically kicking a lot of your customers because you wouldn't just be kicking Greece, you'd be kicking Spain and then Italy, and then we'd have quite a fiasco. So our fundamental view is that the Eurozone hangs together. It's not going to be pretty, and they're going to work through the problems over the course of the next couple of months. Yeah, go ahead.
I was reading something about Germany being intransigent in terms of expecting back everything. If they could lighten up a bit and go for not asking for the whole enchilada, I don't know if they'd ever be willing to do that, but that would seem to be one of the big issues.
Yes, I think in any negotiation, you start with the whole enchilada, and if you get lucky, you take it, but I think that's what's really happening. I think Merkel's party has, its position in the government has been a little bit weaker, and she needs to be showing some strength. But you're absolutely right. I mean, if Germany maintains this position that any new debt that goes out there is senior to everything else that's out that exists today, that's a deal breaker, and I think they'll back off that position. Again, because of these costs. I mean, Germany can't look at the world in isolation. And after all, it was only 8 years ago that Germany was foundering and looking for help from all these other nations to support its business. So I think, on the one hand, they'd like to be tough because they know how hard it was when they put East Germany together with West Germany and all the costs that they've had to bear and how hard that hit the economy. But to be pragmatic about it and to shut down, take the hard line, is going to be very difficult. But, that's more in the political arena, and we're just real estate guys. So that's the way we see things. When we talk to people in the market, they're not assuming that Greece does get tossed out because of what I think are the cataclysmic events that will follow. I think the same people who said we can put a fence around Greece and everything will be just fine are the same ones who said that we could let Dick Fuld and Lehman go and we'll be just in good shape and everything will move along swimmingly. And we've seen that movie. So I think everybody's being a little more cautious about it. I guess my point here is to suggest that really when you look throughout Europe on the ground, and if you travel there, you see that the economy has many of the countries have some fundamental strength. I mean, northern Italy's economy is as strong as southern Germany, which is the strong part of Europe at this point. The northern European countries are in very good shape, actually, quite good shape. The Netherlands, GDP numbers a little better than expected. Their unemployment is 6%. That's not tragic, but it feels bad because they'd rather be at 3%. Well, wouldn't we all? So I think when we really look around Europe, there are a number of positives. And look at Italy is now being brought out as another weak dog in the marketplace, and yet the household net worth, the GDP, is the highest in the world, about 5.5 times. One interesting point about Italy, and the household debt's very low, and one of the reasons people are either mortgage averse or they pay it off quickly is if you do default on your mortgage, you can't open a bank account anywhere for the next 5 years. So they have all these regulations that make over-leveraging a tough problem. And that's our basic view on the market is when you look at the household debt around Europe, with the exception of the UK, it's very moderate. And that means that consumers actually have capital to spend, and I think that's the real issue here. Excuse me, if you're trying to restart the engine, get things moving, and households are leveraged, government's leveraged, you have a big problem to deal with, and when we talk about broader England, that's what you do see. In England, the overall economy is pretty weak. The city of London is very strong, but if you travel anywhere to the outskirts, you see vacant buildings, you see people really struggling to make money, and that's partly the local economy, but also household debt's much higher. It's just harder to dig your way out of that hole. So the point, again, that we're really focusing on here is that things may not be as bad as they seem in Europe. All right, let's get into the real estate stuff because I'm no macroeconomic expert, and I'm getting far afield. On slide 2, just to tell you about what's happening in the general real estate markets around Europe, a couple of big picture comments here. One of the things we do see throughout Europe, and it is a very positive development, is vacancy rates are at moderate levels, and with a few exceptions, and there's not a lot of new development coming down the pipe. And that's all related to the fact that we really can't get financing for real estate, and I'll get into more detail in that in a minute. But in general, as a result of that, you have pretty healthy markets. If you look at London's West End, actually, the vacancy for high-quality real estate is about 0.8%, and not a lot's being built. And one of the things you do see in London, and this does make it a unique kind of area, is that housing prices have gone up quite substantially, so you'd rather develop a residential project than an office project, because today you could get, let's call it conservatively $2,000 a square foot for the residential, and your office project best case you might get $800 or $900. So we have actually seen an interesting phenomenon here where we worried about vacancy in London, but that office vacancy has been turning into residential, and we have less of a challenge. One of the things that is also should be interesting to anyone investing in that market is that while even in London, when we look at the rental rates for office today, they're what we would consider high. 100 at the high end, 80 pounds a square foot, which is West End where there's no vacancy, which works out to, let's call it $130. Now, that is still about 30 to 40% below the peak in U.S. dollar terms, because the pound is weakened, so it's attractive for foreigners coming into the market. And in a global sense, while it's expensive, it's not off the charts. Now, the rest of London and the rest of the West End, that number I gave you is really top locations, is actually pretty reasonably priced on a global basis. So, again, if you're buying property today in London, you're paying up for it, but the rents are not as high as they have been. So what we do see, though, and again, this gets to this is a big picture trend, the demand for real estate throughout Europe is very strong for high-quality, well-located real estate. So when we look at the trend line in cap rates or initial yields throughout Europe, we're actually at a relatively low point, meaning prices are pretty high for prime real estate. And I think it's similar to the government bonds. Everybody's buying yield. We're seeing the same phenomenon in real estate. People are buying yield, but they want fully leased, high-quality buildings, and they're paying up for it. So in our view, that market's actually pretty expensive. When you get outside of town, the numbers fall off pretty dramatically. So there's a big gap between secondary location, secondary quality, and prime and prime. And frankly, it's very interesting to see, because normally you wouldn't expect this to happen if you'd say that the economies are slowing or you're worried about the Eurozone market. That's really not the case. And the demand is coming from local but also international investors, particularly in London. Now, the rest of the markets, one interesting note here are, you guys I know are familiar with Tishman Speyer, Jerry Speyer here in New York. He's actually doing a speculative office building in Frankfurt. You see Frankfurt's got the highest vacancy rates, but Jerry's got a strong sense of the market. And so he's doing a spec office building. But from what I hear from his guys, they're not even bothering to call the banks for construction financing because they know what the answer would be. So they're doing this all equity, which is, again, kind of interesting and kind of a novel approach for Jerry, I'm sure. Now, let's turn to the next page, and because I want to talk about liquidity and what's happening in the market, because this is the real story that has been developing over the last several years. That's slide 3. Banks really have stopped lending to the sector more or less. If you're really good credit, really good deal, you can get bank financing, but it's like pulling teeth. And I'll give you an example. One of the top quality private equity funds in Europe was trying to just renew a line of credit for an office building in Paris, had 5 lenders, each one had about $100 million in the deal, and 4 of the 5 renewed and the 5th didn't, so we had to fill it with equity. And it was, very conservative loan to value. Normally this would be a no-brainer, just a quick phone call, renew the line and move on. Not happening today. Again, that's why Jerry's got to go with his own equity. And the mantra in the market actually today is equity is the new debt. We are seeing a lot of funds, and I'm sure you're familiar with Blackstone. They raised a fund for equity, but they can't find the deals because of the pricing, and so they're moving more into the debt side of the equation. And we hear this every day. So there's a lot of refinancing that has to get done in Europe. Normally would not be an issue, wouldn't have to think about it, but today it's a very different story. Now, filling that void are the not only insurance companies, local insurance companies, but also private equity funds as well. And, I just read about Prudential is starting a new fund, or has already started the fund, which will invest in debt in London, Paris, and major German cities. And again, this is normally they would just do equity, but they're moving into the debt markets to fill in this void. I think, a couple of key points about Europe as opposed to our own U.S. real estate market. We really don't see the kind of lending that occurred and sort of weak quality properties on bank portfolios. Many of the banks in Europe did deals in the U.S. and they've had to restructure those, but we aren't seeing a lot of bad real estate funded by the banks that's sitting on their portfolios. Now it's clear, and I don't dispute this, that we have the tradition in Europe of more forbearance rather than foreclosure. But we talk to banks, we talk to property companies, and we're not really expecting to see this deluge of bad deals hit the market. The only thing out there are what we call these German open-end funds. Now, if you're familiar with this concept, these are like mutual funds that have daily liquidity that invest in real estate. It's a silly concept. It should be blown up anyway. And guess what? When everybody wanted their money out, they want it at the same time, and it's against hard assets which aren't easily liquidated. So out of 90 billion of these open-end funds, 30 billion have closed, and they're closed for a couple of years, then they have 5 years to liquidate their portfolio. So while again I see that's an issue because some of this real estate may hit the market, you have 5 years to get rid of the property. And I think the simple answer there would be if they didn't pay the managers any fees, I think that 5-year time frame might be turned into 1 year, and we'd see that liquidated. But if they're getting fees, there's no incentive to dump this out quickly. Now, yes?
U.S. banks basically can borrow from them to debt, and is that the same situation in Europe? Or is it...
Yeah, in fact, what they do is they do like what a lot of our banks have done too, is you borrow from the Fed and you buy treasuries, or in their case, they bought Spanish and Greek bonds. We'll see how that works out, but they didn't really put the money out. It's a risk-free trade. It was a risk-free trade. So yeah, that's one of the challenges in Europe is that the banks are just very difficult about lending, certainly to the real estate sector. We hear it a little bit on the commercial industrial loans as well. But they're borrowing at a very low cost, of course. But then the question is where they put it. Now remember, what is really messing the market up today is Basel III and Solvency II and all these regulations that are hitting at the same time you're going through the slowdown and tightness of credit. It makes them even tighter on the credit side. So you have to have bigger reserves against any deals you put on the books. And therefore, the bankers are, the easy way out is just buy government paper, take the spread, which is huge, and it saves you a lot of time and energy. So that's a big issue right now. So again, the challenge that we see in the market today is that the banks have left town. There really isn't any commercial mortgage-backed securities market, securitization to speak of in Europe. But what we do have also in droves coming into the European market are foreign funds, sovereign wealth funds, foreign investors of any type. We have a company we've invested in Malaysia. When I was in their office a few months ago, they were telling me about a project they were going to buy in London. It turns out they're the preferred bidder. So going all the way from being a Malaysian home builder to suddenly buying a deal in London is a pretty big jump, but they're all looking to do this. We have actually just happened, a shopping center in the middle of England, Meadowhall, had 5 sovereign wealth bidders from all over the world, Canada, government of Singapore, China, Norway. The Norwegians won the bid, and it's going to go at around a 4.6% yield. Now that's, I think, pretty tight pricing, but there was huge demand for this. It's $1 billion+ investment, and they have the wallets to fill it. So I don't want you to get the idea there's no liquidity in the market. There's a lot of liquidity, but it's coming from a variety of different directions, and it's not local. Again, it's one of the reasons why we feel comfortable with the European market today as opposed to 2008. In 2008, we didn't have transactions, we didn't have liquidity, we didn't have buyers, we didn't have sellers, we didn't have tenants. A whole different world today. But we do clearly see that things have slowed down in terms of tenant activity and just activity in general. Now, I would also attribute that to not only the conundrum that everybody's facing in Greece in the negotiations, but we also have the European Championships, we have Wimbledon, and we have the Olympics, and we have summer vacations. So don't expect a lot of activity. So I wouldn't read too much into the slowness lately.
So it feels
like from the equity perspective, deals that you said Blackstone was turning its fund and turning it into a debt fund, sounds like there's a two-tier market here. There's one pretty fully priced market where the disciplined money stays out. Then there might be other opportunities, but it doesn't sound like the banks are distressed sellers anytime soon. So other than the German open-ended funds, doesn't sound like there's a lot of supply coming to the market anytime soon.
Well, I think that's fair. I don't think there will be a flood of deals hitting the market, but you will see deals that will be coming into the market because of Basel III and Solvency II and, the banks, but I don't see it as the banks suddenly, like we had in the early 1990s, where we saw properties just getting dumped wholesale. That I don't think we'll see. And we've not seen any signs of that. You'll see more product hit the market, but we really have a two-tiered market, and that's absolutely right. It's very high quality, well leased, and that attracts the crowd. And then if it's anything out of town, any kind of vacancy today, you worry about actually filling it. So it's a great idea to buy something at a 7% yield, let's say, in suburban London or suburban Paris. Maybe it's a shopping center deal and it's 20% vacant, but it might only be 20%, it stay 20% vacant, and your IRR might be 7%, not your going in yield, if you get your capital back. So I think that's really where we are today, and I think that's when you see any of the real estate that hits the market, like these German open-end funds, it's really not the high-quality property, because that's been sold already to fund redemptions. And now we're into the more marginal stuff, which is why it may take 5 years to liquidate. Okay, then slide 4, again, just amplifying the story here, and I want to make clear a couple things. One is that the reason foreign investors are attracted to Europe today is not because they are any smarter about what's happening in the Eurozone and the political events, but they look out 2 to 3 years from now and see virtually no supply coming to the market and continually declining vacancy rates. And you're buying today at generally below replacement cost, and certainly below 30 to 40% below the peak valuations, unlike the U.S., which is pretty much close to peak in terms of pricing for real estate. So you do have a very interesting bargain opportunity. Granted, it's out there because the political developments are creating problems. Yeah.
How hard is it to add real estate in Europe? Building in New York City can be a nightmare for many reasons. Is it that difficult in Europe?
Yeah, look, in France it can take 15 years to do a shopping center development. It depends on the market, but like Sweden, they overbuilt it, they went nuts and learned their lesson back in the late 90s during the dot-com boom. But just, to get the approvals, if you're really lucky in London or Paris, you could maybe get a building approved within 3 to 5 years. So we're looking at, that's why I'm excited about this as an investor, because I think we got a 3 to 5 year window here without a lot of supply hitting the market. Now, again, it depends on the city, but look, you try to build Spain, for example, Madrid, Barcelona, you would think they would have huge vacancy rates. Well, they don't. They're in the 5 to 6% range. I mean, all over Europe, we're in that middle single-digit range, because it is very hard to get approvals for deals, and everybody fights them. Plus, it's harder to get financing. So, Germany, Frankfurt is the notable exception. The financial services sector encourages tall buildings. It's the only place around that we see that.
You don't see it in England at all, except when you're in the city.
City is where you have, and you've had a lot of building, and they pulled down some of the cranes or they deferred some of the projects that didn't have capital. I was just meeting with one of the better quality West End developers, and they really won't do anything unless they have substantial pre-leasing. I mean, we're back to really a mature sort of adult world from having left the drunken teenage phase of a few years ago. And really rational thinking abounds. And I haven't seen this in 15 years. So I think that gives me a lot of encouragement just about the fundamentals. And the noise is the political scene. So again, there's a lot of capital that wants to come in the market, but it's hard to find those deals. They're paying up if it's quality. So you'll see very low cap rates. We've seen cap rates as low as 2.5%, 3% in some of the European markets. But some of those buildings haven't traded for hundreds of years either. So it's a little different story. So we like what we see in terms of real estate fundamentals from a demand and supply perspective, and then you guys have to be the judge on the political risk, which is basically where it is today. And you just a quick point too, and then I'll finish up. We have had notably a U.S. REIT, Simon Property Group, bought into a shopping center company in Paris. In order, if they were to try to replicate this, given the time it takes to actually develop in that market, it would take them at least 20 years to pull together this same portfolio. So it's, in a sense, it's a bargain, and they paid a reasonable price, certainly way below replacement cost. But that's really what we have, a lot of well-heeled liquid sharks circling the body here in Europe. But we'll see where that comes out. And with that, I'll hand it over to Nick.
Thank you very much. My name is Nick Cooper, and I'm a principal of the Townsend Group. As you can tell, I'm a Brit, so I don't know whether I'm being circled or not circling or whatever at this point in time. I've worked in real estate for 30 plus years, a lot of that obviously in London and around Europe. I agree with many of these points that have been made here, and I'm not going to reiterate all of them because a lot of them are also contained in the same presentation, which is probably good that we're thinking the same thing, and we didn't collude at all to put this presentation together. But I'd like to highlight to you a couple of things that I think are worthy of thinking about. Firstly, you can look at GDP, you can look at interest rates, you can look at treasuries. In my view, you have to look at one key thing in real estate, and that's employment or unemployment. Because it puts people in shops, it puts people in factories, and it puts people in offices. And Europe-wide has a very different mixed picture, as we know, from Germany at sort of 5%, up probably to Spain today, running at something like 24% adult unemployment. And if you go to youth unemployment, that's running at 50%. So these are difficult days, and they are probably going to be here for some considerable while. And that does give you, from a macro perspective, a fairly difficult outlook in which to work. But exactly as Jim has said, there are pockets around Europe which are worthy of looking at. Northern Italy is one. Central London looks interesting. Still today, Paris looks interesting. And I think the issue that I'd like for you to dwell on really is the issue for me is all about finance. However you look at a market, debt is probably the lubricant that oils the market, oils the wheels that keeps it moving. If you take that debt away, then the market or the wheels are going to grind a little bit. And that's exactly what we're seeing at this point in time. And Jim's right, that the issue that we have going on is a real shortage of debt. It's not a shortage of equity so much, it's a shortage of debt. And it's that debt that's driving the impact on the market. Couple that with this regulatory environment that Jim mentions of Basel III and Solvency II, and I'll show you how that impacts in just a moment. But look, if you turn with me, if you're following this, I'm not going to pick up too much. Page 2 is what I was just going to flick to. If you look at page 2 there, and I use a chart there on the top, this is UK, actually, commercial property prices. They came down a long way, and that's, you would have seen that here in New York. We saw a very similar pattern. You've seen a bounce back, but they're still significantly below their peak levels in many cases. Now, in certain areas they're not, but in many cases the market as a whole is below peak. What we have seen is a very significant flight to quality. Call it a flight to safety, effectively, no surprises there. That's what's been going on. So you have this, I think you used the phrase, perhaps a two-tier market, and I think that is what you see. You've got this very prime stuff, it's good, it's in demand, and you've got everything else. And that's one of the key issues that really sits around the markets today. If you turn on to page 3, this is the point that Vin's making, the same point. Again, good that we pick up the same point. My chart on the left is about private equity real estate funds, an expiry of them. And there's something like 90 odd are going to expire in the next 2 or 3 years. Now, in theory, that real estate will come to market. It might get extended, but there is a potential increase in supply there. The chart on the right is the German open-ended funds, exactly the point that you've just talked about. So there is some stock that's going to come to the market, and I think that's going to keep the opportunity out there. The question is, how do you buy it unless you buy it, as Jerry Spire is doing, with 100% equity, when the debt is in retreat? Go with me to page 4, if you would, and this really, for me, is the key of it. The European commercial real estate position is very different to what you see here in the US. 75% of all commercial real estate debt in Europe is with a bank. Unlike, I think it's about 55 here in the US. Now, if you've got your bank has got problems, and we know, you don't need me to tell you that the banks have some issues here, then that's going to cause some problems. Take it from my own perspective. As I say, I'm a Brit. If you look at the UK today, 60% of all commercial real estate debt is held by the Royal Bank of Scotland, Lloyd's Tier HBOS, as they now call themselves, or NAMA, which is the bad bank for Ireland, Irish investors. 60% of all commercial real estate is in 3 places. It's unsustainable. It's completely unsustainable. Coupled with the fact that I, as a proud Brit, own the Royal Bank of Scotland, I also own a share of Lloyd's as well, and you can see the issue. That loan book has to be reduced, and it will be reduced over a period of time. But here's the problem that the bank gets to. We haven't seen a huge amount of stock come out from the banks. I might venture to suggest that one of the reasons for that is actually they can't afford, in some cases, to take the write-down. Because as soon as you take the write-down, you're hitting your capital reserves. And that's an issue that you see in Europe today. That the bank is under regulatory pressure, clearly to improve its capital reserves, etc. But it doesn't want to take a hit on the other side of the equation that sees that. And you get this phrase that you use well in the US, this kick the can down the road scenario. We see that going on, certainly. And I think you're going to see that continue for a little while to come. But at some point, you have to call it what it is, and you have to start to deal with it. I think it will start to come over the next period. I think you will start to see some of that unwind. Couple this from a regulatory position. If you're working under Basel III as a bank today, if you hold a loan which is more than 50% loan to value, you have to have a disproportionately higher amount of regulatory capital. Now, that's quite a complicated formula, but if you sort of accept my premise that that's what goes on, you hold 51, 52, 50, and so on, you're holding proportionately higher amounts of regulatory capital. What is a bank going to try and do? Bring it back down towards 50%, because then it's a better regulatory capital position. The net result of that is it's currently estimated there's around $226 billion worth of funding gap in Europe today. That has got to come from somewhere, or there will be an impact. And I think it will come from somewhere. I think it will come from new sources coming into the market. You talk about insurance companies, we certainly see that. We certainly see the insurance companies starting to increase the amount of money that they will put in as a loan provision or a loan opportunity. And we think also overseas people will think about that opportunity because on a relative basis, clearly you have some protection on the equity that sits there today. So I think debt is one of the key things, and I've never seen it. In the 30 years I've been like this, I've never seen it in such tight supply. And I'll give you a very personal example of how it is today. I work as a non-executive on a Arab bank property fund. It has bought good secondary properties. They were good in the good times, they're not so good today. It's got vacancy. We have a loan that's up for renewal. We have nobody to talk to. That's not, even if we paid a significant margin, just don't want to entertain the conversation. And that is going to be an issue for the market. And why you're absolutely right to highlight that sort of prime and the rest, really, because that is going to impact in that market. But I think if you...
We have a question.
Sorry.
Quickly, you described that the Norwegian Sovereign Wealth Fund bought a shopping center. That was considered crime?
It's very prime. Very prime. So I think for me that's one of the key issues. If you look at the sort of things that come out as a result of that, if you go to page 7 of this presentation.
Actually, can I just stop you? I want to make sure we address people's questions rather than just go through the book in a very methodical way, if that's all right. Do folks have specific questions? Do you want to take this in any specific direction? Yeah?
Don't worry about it.
Okay.
Page 7. This is a portfolio of student accommodation. It's pretty good quality. It's certainly better than ever I lived in as a student. This is in central London. This is actually being sold by, or was sold by Blackstone out of their portfolio. They've assembled this and sold it. But the buyer here could get a mortgage up to 54%, but couldn't get anything more than that. And there was an opportunity to make what we describe here as a junior debt loan at that sort of 54 to 60% loan to value, secured against these sorts of assets. Now, I thought from a risk-adjusted perspective, I thought that looked a really interesting sort of opportunity. I think fundamentally the real estate is good. I think fundamentally there's likely to be more students in the UK than in the next couple of years, with employment being where it is. I could see that. Mum and dad, like me, are paying the bills of the students, so we all recognise that one at this point in time. But the reality is that was throwing us a cash yield of about 11%. I've never seen those sorts of returns in the 30 years I've worked in real estate today. So, and if you turn the page, this is Poland. Poland's one of the better markets in Europe, actually. It's got a GDP growth of about 3.5%. It's also pretty undershot, as they say. This was a portfolio of 28 retail centres. Needed a little bit of additional loan facility in there. But again, a cash-on-cash yield running at about 12%. I think on a risk-adjusted basis, some of these sorts of things look quite interesting. And as I say, from someone who's worked in this market for a long time now, I've never seen things like that come to market in that sort of way. My final example is really one of, if you like, using opportunity, and that's page 9, this is a building in central London. It was formerly part of the Lehman portfolio, so we know that in clearly bankruptcy. The existing owner doesn't, or the receiver doesn't have the money to do tenant improvements in that building today. You know, it's a pretty good building, but it does need a little bit of work inside. It's got some voids. We're seeing a cash yield in there of 10%. I've never seen that before. So I can paint you a picture that you might turn around and say, oh, this is a market full of risk, and there are some issues in here. Don't run out of here and think, I bet the kitchen sink on this. But I'd also say to you that I think this is a market that has some opportunity in it, that I think selectively, which I think is your point, selectively there may be some really interesting opportunities for the people who hold equity to pick up some really interesting bits of real estate. Chairman, that's sort of really what I wanted to say, and rather than repeat everything that was already said, hopefully that brings the two together.
Any questions?
Yeah, if I could, comparing equity versus debt, and then Europe versus elsewhere, which is the better place for the longer-term investor to go in this cycle over the next few years?
I'll take a stand there.
Go for it, yeah.
I think the debt play in Europe is a very interesting place to be at this point, because you've got generally quite a bit of equity sitting in front of you that could absorb a fall in the market. You're clearly, if markets bounce back significantly, debt clearly doesn't attract rental growth or anything like that. It's a fixed return. But I think some of these returns, particularly, and I've sort of shown a little bit more stretched senior or mezzanine, however you want to call it, I think that is an interesting opportunity that I don't think is going to go away in a hurry. So from a European perspective, an opportunity, I think that has some merit in it today, done selectively, because I think the underlying assets that people might be lending against will be pretty good quality, because you're not going to get that senior loan unless it's a good asset anyway. And you need the senior to get the mezzanine on the top. So I think, one, from that perspective, am I still an investor from a global perspective in the US? Yes, of course. I think, although the economy may be slowing a bit and you've got some issues here, I still think fundamentally there's an interesting time to buy in when you can buy real estate on in many cases, less than the cost of building it. And I think that is not a bad place. It's not the only measure to think, but it's not a bad place to start from today. So I'm rather than say what I single one out to the other, I think you've got to look at your own risk profile as an organisation and decide where you want to place your dollars. I think there are merits in both of them today, certainly in strategies along those lines. I think Europe is probably, in debt terms, 2 to 3 years behind where the US is currently today.
Yeah, I think I would agree. I think, we like high barrier to entry markets, so just fundamentally we like the European zone. Even though you have slow growth, you also have supply that matches up a little bit better. And I totally agree on today I think prime is overbought. There's just too much money chasing too few deals. But the debt side's been left kind of alone. And there is a dearth of debt, as Nick was saying. So when I look around the world, I mean, on the equity side, I like the growth prospects in Asia, and if you can get some good deals in Asia today, that's pretty exciting. But in terms of both debt and equity in Europe, the problem with Europe right now is just hard to find what I think are reasonable return deals. I don't think the shopping center in England in the Midlands at a 4.5 yield is enough for me to get excited about. And when I've got 5 bidders, all of them who can write checks up to $20 billion per ticket, I want to stay out of that game. But there's a real wide open playing field on on the debt side. And I think you go where there are inefficiencies here to the extent you can get the money out the door. But again, in real estate, the most important thing is not economic growth, it's not interest rates, it's supply-demand. You build too many buildings, you've got a problem for a while. We know that better than anybody. I mean, the U.S. is by far the Olympic gold medalist in overbuilding. I mean, nobody comes close to us in trashing a market. And you just don't have that in some of these other areas. So, yeah.
Can I follow? I'm confused. There's this discussion about how tight access to debt is all over the place, and you're talking about there being opportunities on the debt side. I'm hoping maybe you could give some examples or suggest why that is.
Yeah, I think what I was trying to show in that second presentation there were a couple of things. If you look at that page 7 on this presentation there, that's something that was just around. It was around a couple of months ago of an opportunity where there was an ability to make a loan against that portfolio. And I thought that was pretty well secured. Fundamentally, those are good buildings. They're new buildings. They've got a good occupancy in them, good student occupancy. And you're seeing lending in the last dollar at 61%, which means you've got, 39% of equity sitting in front of you. So that gives me some comfort that there's a nice bridgehead there. And that's the sort of thing that I think is out there today.
But I think the key point is, as we were talking about earlier, is it's really that the banks, and as Nick mentioned, that's always the deal. When anybody in real estate, you pull together a group of banks, and they finance everything. And you don't have securitization, you don't really have that many options that you would go to. Now, that one big source of capital has been taken off the table, more or less. And when I first heard about some things you guys are thinking about, the challenge is finding deals. And I think you have, or your advisors have found you a pretty interesting situation, because that's what everybody likes the idea of buying into the debt side of the equation. It's not so easy to figure out how. Because the banks aren't exactly coming to you and saying, I've got to fill a few of these buckets, send me your money. You've got to sort of dredge it out of them. So, it's not, we're not suggesting that all these wonderful deals are out there just sitting on the tree for you to pluck them. That's definitely not the case. But we do have situations like this private equity firm that has never had trouble raising capital anywhere. And 4 out of 5 banks say yes, 1 says no, and he's got a $100 million hole to fill right away because the loan matures in 30 days, nobody home for that last $100 million piece. Yet he fortunately had it in his own pocket to fill it with institutional money coming from the U.S. But that's really what we see happening. So it's more a matter of we have this displacement of capital in Europe that you're trying to take advantage of. And we're not saying that won't get filled quickly either, because you're not the only ones. We're not the only ones to see it. I mean, all the private equity firms, Blackstone 2 years ago identified this as a better opportunity than equity, and then they've started to go ahead and find the deals. But that's really the challenge: is finding the deals and then deciding whether they're good. And the other key thing is loan to values in Europe are lower than they are in the U.S. generally anyway, and values are pretty solid. Again, I come back to that supply-demand situation where values are holding their own and look a lot better in the next few years. So I'm looking at this market saying, I want to be positioned in the real estate business today because of what I see happening 3 years from now. And how I get there is the critical issue. If I can get in their debt, secured, LTV below 70%, that's great. And if I can make more than 5-6%, even better. And I couldn't do that because I got outbid by the banks. I mean, I've done deals in Europe where I had a mezzanine and the bank came in, took out the mezzanine, took the whole deal, and brought it at 100 basis points lower than we were prepared to do it on the mezz. So, but that same bank group is not in the game anymore. That's over.
We have one more question, and we should probably move on.
Actually, answered.
He did? Okay. Great. Thank you all very much.
Thank you.
Thank you.
Madam Chair. Madam Chair.
Yes.
Is it appropriate to take a brief break?
Yeah, I think we're going to mush on through the lunch, so let's take individual breaks rather than a group break, because everybody's been doing that, going in and out anytime. You may absolutely. Great, that's the answer. Oracle has spoken.
You made a mistake, we have to hear.
I'm a child lawyer. I can see it.
Okay, so we have three separate matters which are all pretty straightforward. I know it's a kiss of death, but it's just trying to set you guys up. This should be pretty straightforward stuff. One is an update on the procurement process changes we'd like to do, and I'll hand it over to Tony and Dad. Where's Dad and Tony?
Good afternoon. I'm here to discuss a proposed amendment to the procurement policy board rules with respect to the negotiated acquisition rule.
Don't forget the stenographer.
Ready?
Tony, you might say your last name.
You want to say my last name? My last name is Del Olio, D-E-L-L-O-L-I-O. First name Anthony, Tony. You guys should have a handout. Should be nice, about 3 pages, proposed amendment to PPP rules.
So if I may?
Yeah, go ahead.
Just one of the things I'd like to bring to the board's attention, the change to the existing rules that Tony, who's the controller's ACO and our procurement expert in the office, is going to speak about is separate and apart from the negotiated acquisition conversations that we've been having. I think the controller's office has heard many of the issues that the board's articulated, and I think that we've looked at the existing rules, and I would tell you try to make some tweaks to give the controller's office and the board added flexibility. Obviously, if and when we're successful in making these adjustments, any decisions would be made as we make all our other decisions here at the board. But I just want to stress this is separate and apart from some of the other broader topics that we've been having.
You mean separate and apart from the pilot?
From the innovative procurement, right. So this is what I would term a tweak to some of the existing rules to give the trustees and the controller's office some added flexibility in our day-to-day business.
So negotiated acquisition is a method of procurement that allows for negotiating directly with a vendor without issuing a competitive solicitation. It is allowed under limited circumstances, when there's a time-sensitive, time-compelling need, or a limited pool of suppliers, and where using a competitive method would not be feasible. The PPP rules currently prohibit the use of negotiated acquisition to procure investment manager services, except in limited circumstances with respect to the emerging manager program. So we are working to address this anomaly because it allows, the rules allow for any other professional services or anything else to be done by negotiated acquisition except for investment managers. So we're trying to, what is basically an anomaly to cure this anomaly by allowing negotiated acquisition in the same manner, in the same circumstances that anybody else could use it for whatever professional services, goods, construction. The amendment will provide the investment boards with an additional procurement tool to use when appropriate. One of the benefits is allows for contract extensions for existing managers who have good performance, and those contracts would otherwise expire. The other part is the emerging manager program.
Hang on. Let's just make sure we know what we're talking about, okay? So we have 300 managers. Every now and then a contract expires. It's on its last extension. Typical contract is 3 years for 2 3-year extensions, so you get to the end of the 9th year, and your contract can expire. The only way, if it's a public manager, to avoid that is to start an entire RFP process for that asset class, which seems like cranking up a humongous machine for one manager's problem. We ran into this a couple of times in the last 12 months, and we had to let a manager go because their contract expired. This will alleviate that. Because what this amendment will let us do is basically give another extension to the vendor. So again, we come to the board, it wouldn't be anything the controller's office does by itself, but come to the board and say, hey, look, this is happening. What do you guys think? Here's the performance. Give them an extension or let them terminate. And if you terminate, we have to reallocate the assets. So again, we had some real life examples of this, particularly in this board. This is how you fix it. Okay?
Larry, you have a question?
How long will these extensions last? Are they time limited? I mean, in other words, it's not the equivalent of renewing the contract.
No, that would be up to the board. It's not, the rule would not sort of restrict it in any way, but the board can decide how long, pursuant to, competitive procurement laws. So you don't want to make it, you won't be able to make it too long, but, generally they're a year, sometimes 2, depending on the need.
John.
And just to clarify, the only amendment you're looking to make to the PPD rules in this section is in those particular cases where contracts have terminated.
Yes, when they expire on your face and you kind of like the manager, and you're just stuck. Yeah, we had that.
Yeah, no, I remember we didn't, and that was a problem, but...
Right.
Okay, and so just to follow up on that question, you are not looking to use negotiated acquisitions when there's a limited pool of managers or when there's an expeditious need to hire a manager?
No, we have that right already. That's what the negotiated acquisition is. So, for instance, before you arrive, we used the negotiated acquisition process when we found out that 2 of our index managers had merged, and there were only 4 providers of index funds. So we used this provision to do it fast.
So I might be misunderstanding what Tony had said, that we don't currently have the ability to use negotiated acquisitions today. Is that
For investment managers, that's
for
correct.
investment managers?
No, that's not right. Because we do have the ability to use it. You have to get the circumstances. This provision is one very, very small thing. The small thing is if our manager's contract expires, we want to amend the rules so that we can extend that one manager's contract without a whole big process, a whole big RFP. Right? In which case, we'll come to the board and say, here's what's going on. We actually won't wait till it ends. We'll say, this is going to happen in the next 3-4 months. What do you want to do? Let's give them an extension, 1 year, 2 years, and then we're done. Just that one manager.
Lara, did we have something happening at the end of 2011 with the manager?
Yes, we did.
It was quite good, and the 9 years was up, and therefore we couldn't take them in.
Yes. This is going to cure that.
Yes.
Exactly what it's going to do.
Well, I mean, to be a little more accurate about what happened was that we used the private procurement process, and that manager wasn't one of the managers.
No, that was later.
That came later.
Nothing to do with it.
That was later.
That's not how I recall it.
It was, because it was the end of 2011, when this manager's 9 years were up at 12/31/11. The 9 years were up.
So Tony, the law allows us 9 years, right? That's why we have this thing that we have to, or some directive. You can tell me what the legal aspect.
I believe it's more of the sort of concept that anything beyond that is not competitive under state law. There is no rule that says you can't go beyond 9 years, or a rule that says you can go up to 9 years. It's just considered sort of appropriate under the circumstances that 9 years is not considered anti-competitive for purposes of investment management.
Right, so it's that 9-year issue, that's it, right, that they're talking about?
Well, we believe that our contracts, which go 3, 3, and 3, 3 years original term and two renewals of 3 years, for a total of 9 years, is not anti-competitive under state law. Doesn't mean that a 10-year term would not also be competitive.
Okay, I think there was a double negative, so I didn't understand. Can you speak non-legalese, please?
It's not easy.
You're asking.
Let me take a stab at it.
Someone without a legal background can do it non-legally.
Are you asking, is it limited to this one?
I'm just trying to understand what it is so we're dealing with some state law or something that says after 9 years.
So let me take a step back for a second, if I may. So right now, we have contracts that, to your point, often last 9 years, but they can also be for other terms. So if you have a contract that's expiring and we don't have a procurement mechanism, rather than lose, in this circumstance that Larry points out, a good manager, we are able to use negotiated acquisition until the controller's office and the boards decide how they want to go forward to retain that manager. So right now, the PPP rules, they don't really allow us to use negotiated acquisition for investment services, even though they're allowed in other places to buy other products. So I would tell you this would do two things. It will allow you to keep a manager who's done well for you, whether the term is 9 years, 6 years, you can make it up. You're sort of out of bonus points, I would tell you, to keep them. So you need to use this process. And second, it's a question of equity or of being equitable. There are other places for other services in the city that need to use negotiated acquisition. We're saying that investment management should be included under this umbrella.
So I actually understand what you want us to do, but now you confuse me with the 9 and 6.
So I was just trying to give you an example.
So essentially, is there a state law that does not allow you, some law that does not allow you, us to extend contracts beyond a certain period, and is that what we're addressing? What is the issue we're addressing?
I'll make it real simple. We're addressing the expiration of a contract. If a contract expires with a manager, we can't do anything about it.
The first 3 years or the last 9 years? No, but
When
we
it's
don't,
final expiration.
final.
Final
Which is
expiration.
what? But to be
9.
specific.
3 plus 3 plus 3.
So it is 9, right?
It could be.
That's challenging, if I may. There is no law that says clearly you cannot go beyond 9 years. There is a state law that says we cannot enter into contracts that are anti-competitive, so we sign up somebody for 50 years, 40 years. What we're saying is the pattern of practice in the past has been 9 years is a comfortable level for everybody. We were free injury and not come against that border. That's just the policy procurement rules. That's just practice has come up. Maybe 10 years would take us closer to the end, but not over, but no one has gotten to the point of actually testing that. Am I right? So we're saying in this case, it's almost as if we're entering into a new contract for a year or 2 years as a negotiated acquisition at the end of the term of the existing contract with the existing manager.
Right, but it could actually go to 9 years, right? Again.
Well,
we don't do one and two. We do 2-year contracts at a minimum or no?
Not as a negotiated acquisition. Negotiated acquisition, the rules are a bit tighter. You don't want to go to 9 years of that because then it's something that way.
It's just a bridge to the next selection.
Got it.
I think Al said it correctly. It's just a bridge. Right now, we have, the vendor runs into a brick wall, which is not fair to them, and it's not fair to us.
So we could start the process in the instant.
We can start a process when we want. This is a single manager has a problem, as opposed to we want to do an RFP for new cat manager.
Exactly.
We can do an RFP whenever we want,
Got it.
but this one manager might have a problem.
But it's only a 1 or 2
And
year
there are
extension.
other circumstances where that could happen, and that's where a manager goes away. And we need to get another manager quickly, right?
But we have that right anyway because of time restraints and emergency matters.
So you still have to come back to the boards to ensure that we can actually make that year extension, right? So the boards get to review at that time. We review performance, we review a standard package from our consultant and from you all as to why we should keep them, et cetera, yes?
Yes. Yes. This is trying to just get the ability to have that conversation with the board. Because right now, it runs into a brick wall.
Yeah, no, I agree.
Right? Okay. So that's the first one. You all clear?
Yeah, well, there, the mechanism, you said you have a 300 manager,
Yes.
and I assume that it's not just one that expires this month, one next month. So once you sign that expires in the same.
In general.
So will there be a process to begin to renew, where you have a number?
Yeah, well, there's a number of them.
And you want...
The number tends to come if there's an RFP. They were all hired at the same time, they all expire at the same time. Right? So then you have an RFP. When we see it coming. Like if we give everyone a 9-year contract, let's say.
Sure.
At the same day, they're all going to expire at the same time.
Right.
Just every now and then, for some reason, we bump into someone who got hired along the way, or maybe in the old days there was an RFP that happened, and during that 9-year period, some of the managers, well, let's say all the other managers got fired along the way, and he's the last guy left, and there was no pool, because it might have been pre-pool, because now there's a pool of candidates, and we're stuck. Perhaps in my case, I just said we'd start an RFP process, right? But this whole thing is really for the one-offs as opposed to change the entire way to do business. Because again, we had this problem at the end of last year, and it was bad all around, but we were stuck with the rules. So again, this is the one-off bridge to RFP is the right way to look at it. Okay? All right, that's number 1. Number 2?
So number 2 deals with graduation of emerging managers. Right now, at best, the rule's unclear about the Controller's Office and the Board's ability to graduate those underlying emerging managers who are part of emerging management programs. This would clarify the ability of the Controller's Office and the Board to graduate well-performing sub-managers to direct contract from the Board.
Yeah.
Is there a dollar figure involved here that one would then determine that this part of the funded funds would 2 billion, $1 billion? Is there any number involved where we graduate from that because of a number?
We've talked previously about numbers in terms of would no longer be considered an emerging manager, but in the contemplation of this rule, we don't actually put a number on it, Pat. We're looking more, I think, at performance and those folks who the Controller's Office and the Board, we feel have the capacity and the systems to be a standalone manager.
Again, Pat, this is just trying to get the ability to graduate somebody. The way it's set up now,
No, I
we
understand
can't
that,
graduate.
but I wanted to kind of flesh it out a little bit. And I would ask in the future, because this is important, I would put it in the board package or for this.
I have no idea why it wasn't in the board package.
Pardon?
It should have been in the board package.
So, I have a question. The cover of the document says proposed amendment, and I'm not sure a lot of things wrong with that, but to me it sounds like the language in both of these are providing kind of context for how you'd like the amendment to sound. Is someone going to actually draft the amendment? Or are these amendments?
There would be, yes, it would be an amendment to an existing rule in the PPP rule.
Well, my question is a little different. Not around the word. So,
This isn't the words.
yeah, that's my point. Like, who's going to write the words?
We've already written them, they're in draft, we can share
So
them.
when we get to look at them, so some of these questions about what time frames or everything else is not, do I have to ask you? This is just framework language, doesn't help anybody, I don't think.
Okay, we can definitely share that with,
It
again,
seems like the board wants to approve the final language. I don't know. I don't know how, this is my first day here.
not
At
really.
the last meeting, we had agreed that any resolution would be in writing. And so I think to the extent that you need a resolution for this,
Well, I guess I would say that a couple of things. One, we're happy to send the language around. I think to Tony's point, the actual adoption would be through the PPB. So we were approaching this as sort of not a matter for resolution, but one for the board, as we've done in the past, to note the actions that we're pursuing vis-a-vis trying to achieve a change to the PPB, and then report it to the board. So ultimately, it's up to the board, but that was sort of the framework that we were working under.
It doesn't obligate, the amendment to the rule doesn't obligate the boards or the controller's office to do anything with respect.
Yeah, I want to be
Just
clear about
additional
my points. I think some points are meshing. For me, look, I'm new at this, and I'm learning, but I want to see language. And if there's language, if there's an amendment, I want to see it and read it before I have a definitive opinion. That's kind of
I'm sorry, I got to interject one of my comments about the role of the board. Obviously, you can do anything you want, but I think the Controller's Office is bringing you here a couple of policy issues that help them in their day-to-day carrying out of your policy directives. The board can't look at every gory detail of everything. Policy procurement rules, I imagine, are fairly technically complex, and that the experts normally would be the ones you would rely upon to actually carry it out. Now, as I say, I've made this comment on things from hiring managers and everything else. The board should deal with policy issues and should not get down into the minutia. And so, sorry, I gave my comment again.
Well, I think, to a certain extent, you're right, but there is a fine line of, whose definition of minutia. And I think that that's, part of corporate government, good governance here is we have to determine how far down we want to go without, micromanaging it. So there's a certain level of detail that helps us understand what the policy is. I think it's rational to say in that language for us to know that the contract
won't exceed 2 years on, on item number 1, for example. And maybe in item number 2, and this is probably for discussion, maybe it makes sense to put some meat on the bone for graduation. I don't think anybody's against graduation, but, how do you do it? What does it mean? And from a policy standpoint. And once we've set the policy, you're going to graduate, you're going to do what you need to do. So I think there's a certain amount of detail that would be very helpful.
David, if I may, to your point, and well taken, I think in terms of achieving a rule change to give the board that flexibility, I think what you're suggesting is sort of something that happens at this table apart from sort of bring those specifics to the PPB. I think what we've tried to do is create a framework to allow it to happen, but not put those necessarily into the rules. I think there's a line there, if you will, between making a procurement change at the procurement board and then the board sort of delving into some of the issues that you've articulated.
John and then Ken.
If I may, I'm a little bit confused here. I mean, Thad, you can help me out. The people who will make the amendment to the PPP rules are not us, as I understand it, but the PPP board?
Correct.
So the board itself would amend its own rules. We're going to ask them, actually I shouldn't say we, Dan is going to ask them to make these changes. To suggest changes in the process, is that right?
Yes, we're in the process.
Okay. So is the board going to make the request of the PPP to make the change, or is Dan going to make the request?
Dan is working with the PPP, various PPP entities, which includes representation from the mayor and our office and law department, and would like to be able to give the representation that the boards have been advised of this and are essentially supportive.
Okay. So you're asking, that's what I'm saying, do you want a resolution for us supporting the name change, supporting the change to the text?
If that's how the board would like to go forward, that'd be great.
That's what I'm not sure about from the presentation.
Yeah, I wasn't looking for one. I thought we were sort of updating the board on what we were doing, for more information, but if it's a comfort level, it's a board decision.
Okay. I want to be clear.
We were executing on things that we already discussed. If you go back 6 months, 3 months, a bunch of times, this board has said, hey, let's have a graduation policy. We came back, I think it was 6 months ago, and said, let's go figure it out. Because again, it deals with the PPP and it's complicated. So this is the update on figuring it out. And instead of doing it one thing, which is we had this contract that expired on its face, we're going to go to the PPP with 2 things. We got this graduation thing, which we decided 6 or 9 months ago didn't work because the plumbing's not hooked up. So we're going to fix the plumbing of graduation, and we're going to fix the ability to not have our managers run to brick walls. So this was trying to update the board to what we're going to do. In case you hear about it, don't be surprised, because we're now actually going to go do something that we talked about before.
Pat and then Al.
Yeah, just to clarify this, in the fund of funds, we want to graduate one of the managers because of good performance, etc. It would come back to the board to determine how much additional monies we want to give them or whatever it is, correct?
Absolutely. Yes.
Okay. Same time.
3 things. One, whatever the rule, however the rules are changed, and whatever the language is in the rule change, we want it to be as broad and general as possible, and then the board will make the policy and set the criteria about how those changes in the rules are going to be implemented for this board. Okay, so I don't think we need to, the actual language for the rule changes need to have all the bells and whistles that we would put in for policy, or for policy criteria. Second thing is, this board is full of lawyers. People want to see, I mean, I'm assuming, Tony, you're going to give them proposed language, right?
Sure. Absolutely.
Okay. I would like to see the language before it's sent to the board. People on the board may have useful comments, you know. but we'd like to know what the proposed language is.
And as you know, again, when you get the PPB to vote it into capital, which is the city administrative procedure act, you got a 30-day comment period, so everybody can comment on it.
Right.
So,
But I think since this is being done for the benefit of this board and the other pension boards, that it would, some of us would like to see the language. And the third thing is that I really don't like discussing these kinds of things without this being presented in the board book. There's just been too many times in the last few years where we've been presented with things to either vote on or to tacitly agree to without having the chance to really read them and, chew them around a little bit. So I would just ask BAM to make sure that whenever we're expected to discuss something or to agree to something or to pass a resolution, that, we're given more time to actually look at it.
We'll get that into the book.
Al, I'm surprised it wasn't in the book.
Okay.
Okay, so what is our next action step, Thad?
So we will circulate the proposed rule to the board members, and I guess that'll come through me, Tony, if that's all right. And then any comments folks have, if you send them to me, we'll work with our council and move forward.
Do you need anything from us today?
No.
Okay.
Okay, thanks. David? Yes. David.
Right, he's been
right here.
Flushing is roughly...
Right, you know it. That's going to open it.
If I can draw the board's attention. Thank you. So I can draw the board's attention to page 109. And I guess I'd like to start off first with apology to the board. I think we had a handout that we distributed. I thought that it was in the package, but I think we had some reproduction issues, so it didn't get into the package. But the resolution before you today is entitled the Contract Manager Resolution. And I think it's important to know that this is a resolution that we bring to the board every time, every point at the end of the fiscal year. For better than the last 15 years, the board has adopted a resolution recognizing the controller as the contract manager. And what that means is that once the board articulates decisions, the controller as the contract manager manages that contract process and executes those contracts. So that's what the resolution is for you today. And it's the same resolution that we passed, I said, for at least the last 15 years. Nothing has changed in terms of the substance other than to reflect the coming fiscal year.
I'm sorry, what is the resolution?
So the resolution, it's called the Board's Contract Manager Resolution, and it's on page 109 of the book.
Thank you.
Starts at 110. Starts at 110. 110.
The resolution's on 110.
Thad, this falls under, in my words, minutia.
Well, Larry, I think to the extent that we've been doing this for the last 15 or so years, and that the resolution hasn't changed in that time, I think that's one way to look at it, yes.
So can we just explain to people what the resolution's about and then be done?
So as I tried to mention, the resolution codifies that the controller, once the board makes decisions on managers that it wants to hire, that the controller is the manager of the contract process, and this allows us to continue in that role. So that's what the resolution does.
This allows you to negotiate on our behalf
And execute the contracts, Madam Chair.
Thank you. And so this, what you
So
just
this-
handed out now is just backup
Past practice has been that we share the fees that have already been published in the NYCERS CAFRA with you during this same time that you would look at the contract.
The reason this wasn't in the book?
That was my fault. Pure and simple.
In that case.
It was done. Pure and simple. It's done. So I think, Madam Chair, we do need a resolution in this matter. The board has adopted this resolution previously, so looking to have a resolution passed.
And you said the language has not, the language is the way it's always been over the last
At least 15 years. Yes, that's correct.
Any discussion or questions? Do I have a motion to approve this resolution? Second. Any against? Motion carries.
Thank you. Excellently presented.
And thank you for having this writing, that's actually very helpful.
Okay, one more resolution and have lunch. This has to do with the law department attending our meetings. I believe that I
Clerk is a corner here.
that is, who's by all means, sit here. This is next. You're on a roll, buddy.
Hello, everyone. So this issue has been on the board's agenda a number of times, but just to briefly sum up the history. So in February, the board passed a resolution requiring that the law department attend all executive sessions. Since then, the mayor's office has tried to arrive at what we think is a reasonable compromise, considering the law department's limited resources and the board's needs. So the resolution that's in the board package today reflects the most recent proposed amendment to the February resolution. And I just note for the board that today's resolution provides both that the law department would be at the board for at least 1 hour at a prearranged time to provide counsel to the board. In addition, the law department would be available by telephone at any other time during the executive session if there were questions from the board. So the mayor's office thinks that this is a reasonable compromise and that this should both provide the board with counsel and, take account of the law department's limited resources. So I'd make a motion to approve the proposed amended resolution, but if there's any discussion, we could certainly do that. Yes?
Do you intend to do this for the regular board meeting as well?
No.
Why not?
The resolution...
It's come up here.
Well, yeah, it's the resolution was passed just for the investment meetings to require the board to attend the executive session, and I think the law department had resource problems attending that full meeting, so that's how the issue came up. It hasn't come up at the regular meeting.
But you don't intend to bring it up, or you haven't thought about bringing it up at the regular meeting?
The situation just hasn't presented itself at the regular meeting. Yes.
Pat, just to clarify, we've never indicated that we would not attend the full session of regular meetings.
So that's why I'm asking, if you intend to do the same thing by telephone and...
No, we've never indicated that we would not be
Why
here.
not? My question is, do you want to do it here?
Because we believe that we provide more to you at the regular board meetings.
More?
Yes. We do not attend any of the best meetings of any of the boards, but we attend all the regular meetings.
No, I understand you, but I don't quite get it. Maybe other people understand it.
And it's not simply about resources, it's just about the needs of the board and the usefulness of having an attorney there the whole time. I've been here for quite a number of hours now.
There's another question that comes to mind. We're not involved with deferred comp. We don't sit on the deferred comp board. But I understand that there were 3 lawyers there at the last meeting. Is that accurate? Was that 3 lawyers for the deferred comp, which is the investments? And here it was present during the entire meeting, and not here.
Generally, those meetings, I'm not sure the exact number, Pat, but those meetings generally are about 2 hours long.
Is the time factor?
Time is a factor.
I would point out they are getting longer though. Just for the record, 2 hours is the time that best for the panel, so. Kind of like the NYCERS meetings themselves.
John?
Madam Chair, I reviewed the resolution, and I appreciate the effort that was put into it. I just have, if we're going to proceed with the vote, I haven't heard a second yet, but I want to say, if we are going to proceed with the vote on that, I would like 2 changes to be made to the resolution. And if people direct your attention to page 112, just to see, my preference is, and my motion would be, to remove the first whereas clause. This is whereas the New York City Road Department has agreed to attend investment meetings if and when legal matters are scheduled. I think that should be stricken. I don't, particularly have a great interest in knowing that they agreed to be here, since they're lawyers, it's kind of up to us if they're here or not. So I'd like that removed. And the second change I would like is on the last whereas clause. Whereas the Board of Trustees agrees that this proposal will provide the Board with competent and timely legal advice. I don't know that I can speak to the future, and I would like to change that to whereas the Board of Trustees agrees that this proposal should provide the Board with competent and timely legal advice. So I would just propose those 2 changes.
So John, just a technical point, Karen's advising me that we need a second before we can do anything.
But we're in discussion phase, so if we need to put it out there, and that's just have include that in the conversation or the discussion. I said at the beginning, we haven't had a second yet, but it was taken up. So I'll do microphone. So, I don't know if there's any other discussion.
Any other discussion on this?
Well, I would think that the board should be able to really determine when the law department should be here. I mean, I think what we're doing here is we're allowing the law department to conserve its resources in a way that I think is more than reasonable. But I really don't think the board should have to get in a negotiation with the law department about when they need them for that hour. So I would strike the language at a time mutually agreed upon by the law department and the Board of Trustees.
So Al, you're just saying you'd be in support of the resolution, but the board would decide if the law department would arrive at 2 p.m. rather than stuff?
Yeah, I mean, I really don't want to get in a negotiation with them about when that will be.
So you want to change, if I can just clarify, the last line you want to change for at least 1 hour at a time dictated by the Board of Trustees?
Yes. Or determined. Dictated sounds a little.
I like dictated, but that's
So do we have any further discussion or suggested amendments if we do get a second?
Yeah, I'll second. I was going to say, Madam Chair, I'll second it, but, and then I'll second your motion, and then make my motion to make the amendments I have, and I'll adopt Al's change in my motion well, if you let me.
That would be more than happy.
And one amendment.
Absolutely. So, as suggested by our executive director, I think we now have a motion seconded to pass the resolution as amended by both Mr. Zacconi and Mr. Rodriguez, correct? So we'll take a roll call vote.
I'd just like to see what it reads like now. Someone read it out. Can these be amendments?
He wants to see how it reads now.
Well,
I mean, you don't have to ignore.
yeah, I was kind of following them.
So the first whereas clause would be whereas the Board of Trustees thereafter resolved that an attorney from the law department attend the entire period of executive sessions of the investment meetings of the NYCERS board, and whereas the mayor's office has proposed to have an attorney attend executive sessions of the investment meetings of the NYCERS board for at least 1 hour at a time mutually agreed upon by the law department. We have to change that also. At least 1 hour at a time determined by the Board of Trustees to provide advice and counsel on any and all issues that may have arisen in each investment meeting. And whereas the law department has agreed to be available by telephone during times when it is not present at the executive sessions of the investment meeting of the Board of Trustees. And whereas the Board of Trustees agrees that this proposal should provide the board with competent and timely legal advice. Now therefore be it resolved that the Board of Trustees amends its earlier resolution to the extent needed to provide that the Board requests an attorney from the Law Department to attend each executive session of investment meetings of the NYCERS Board of Trustees for at least 1 hour at a time determined by the Board of Trustees.
Okay. Can you roll call vote? Chair? Yes. Controller's Office?
No.
Public Advocate's Office?
No.
Borough President Manhattan?
No.
Borough President Brooklyn? No. Borough President Queens?
Yes.
Borough President Staten Island?
Yes.
Borough President Bronx?
Yes.
International Brotherhood of Teamsters?
No.
Transport Workers Union?
No.
District Council 37?
No.
Motion does not carry, no concurrence.
So where does that leave us?
This is where we want.
The prior resolution still in effect, I believe.
We had requested Dan to move the discussion of the bank loan investment policy statement to the public session. So can we have that conversation now, because it's a policy matter, and all policy matters are discussed in public session with the cameras on. So we don't want to go into executive session yet, because we still have a matter, that's a policy matter for the board.
So I'm a little confused, I guess. I think we had some conversations with the law department, and we certainly recognize the importance for part of the conversation of being in public session, because the nature of the conversation, I believe in constitution of the law department, it was going to remain where it was in the agenda, and those portions of the conversation that were tied to public session to be was going in and out as need be, so that the board could have a full discussion, but that it was not contemplated that we would be changing the agenda and separating out in the senses articulated by the chair.
That's what I understand as well. I had communications with Janice and Paul where we indicated that the controller's office felt strongly that they needed to provide some context for the bank loan issues that will be discussed in public session, so that we first wanted to provide that context in executive session and go back to the public session. Again, recorded and made public once that discussion has been made.
So,
Which is my understanding of the advice that Dr. Jones had.
well, it's what we heard, I'm not sure we agreed, so we'd like to have this conversation with the board, which is, an investment policy statement is simply the document that talks about what we're going to do as a matter of policy. There's nothing sensitive in an investment policy statement. So we've already had our board education. We're just trying to clarify and understand. So we've had our board education. Why can't we just move to, as we have on all other matters, have the investment policy discussion?
So again, I guess I'm a little confused only because we did have this conversation with the board's council, and we thought that it would be most beneficial to have a discussion and go in and out as appropriate, and I believe that the law department concurred with the presentation was articulated that we were going forward. And a little surprised that we're having this discussion at the end.
Well, Sad, we don't, we want to talk to you, I mean, we want to talk in front of the board, so here we
I
go.
will tell you that the question is to process, if you will, and we appropriately, I believe, discuss that with the board's council as to your office. And
But we are still asking for a discussion with the board.
I'll rely on what I'm not in a position that I would rely on what our attorney in the law department says, and it's nice that they're here today. That's not what we were told, Mr. Bondari.
So the issues that were presented to me last week by some of the trustees were whether or not the agenda needed to be amended to add this item. I said no, that formally amended. I said no. No law that requires that. The other question was whether or not something in public session had to be reported. Again, the answer is no, but it is your choice to commit that. I thought we reached a reasonable resolution on this issue. The Controller's Office agrees that discussion of the policy statement should be in public session, and agrees that it should be reported and made public, and it will be, but that they need to provide context for that discussion first, that should most appropriately be discussed in executive session. So I'm not sure what the issues are.
Yeah, we're not.
I think the issue is, we're trying to, I mean, there's an RFP that we're talking about, that managers' names in it, provides the background for the discussion of the size of the allocation, potential managers, and as part of that, there's an amendment to the IPS to let you do leverage loans. We talk about the amendment before you actually talk about what it is, seems backward. So what we were saying is, let's go through the whole process, talk to everybody, walk through the recommendation, agree, if we're going to agree. They go back onto the public session to talk about what needs to be amended in the IPS to actually have that transaction.
We don't have an IPS now, right? You're talking.
No, the big IPS, we have an IPS. This is an amendment to it to allow an asset class. But let's talk about the asset class and the managers in executive session.
Oh, I fully agree with the managers, but we're very confused about why an asset class IPS isn't a standalone conversation, which has nothing to do with the managers or anything else. That's how we've done
I think
it.
that's what you just said, Ronchi, is that they are two separate things.
Yeah.
I think Larry's just saying, he's just saying the order of it should be the executive portion of it first, and then the public portion of it second. It's
just get everybody all up to speed about the whole concept before we then say, all right, now document it like this. It's not hard to document it unless it's first other conversation.
So we'll move to the bank club, because we want the cameras on, we want everything recorded. It should just be like a normal public session. So we'll come back to all of that?
Yes, we'll come back to that as soon as we go into executive session, talk about the whole thing. So we'll come back.
Okay, let's just do that.
So you want to do lunch?
Yes.
Yeah, in the motion going to session.
So many different people speaking so many different languages that.
Okay.
Well, we're set.
Are we good to go? Okay, so Martin, will you walk us through the investment policy, please?
Sure. So there are two places that you can find this in the board package. In our long Word document that contains all the statistics and information, it's Appendix G on page 290. We also have a PowerPoint that follows that directly, and it's an appendix that starts, actually the page number is blacked out on top, but it's page 13 on the bottom, 13 pages later. What we did was we looked at the existing investment policy statement for asset classes such as high yield, such as 4+5, such as TIPS, U.S. equity, and so on, and took the language in there, applied it to bank loans, leverage loans as we refer to them here, and came up with a policy that describes leverage loan policy here. This does not include the overall asset allocation that we're recommending, which is 2/3, 1/3, which would go into the asset allocation piece if the board wishes to adopt that. So this is simply the investment policy statement that will be added, because it doesn't exist right now, that describes leverage loans.
Martin, I believe, when working on the investment policy statement, but this is something that you worked with Callan and
Yes.
represents.
We reviewed it after it was put together, and we thought that it was okay to as is.
Thank you.
So, Brett, can you comment on your opinion with regard to, so let me just backtrack. leveraged loans are a sub-asset class of high yield, right? Is this what we are saying?
Yes.
And so you're recommending that with regard to policy, the sub-asset class allocation to high yield, to bank loans within the high yield sector, that it be 25% versus Van's recommendation of 1/3? Can you talk about that a little bit?
Yeah, that's more of an asset allocation as opposed to the policy here. But yes, we would feel more comfortable with bank loans representing 1/4 of the high yield allocation as opposed to 1/3. And our reason for that is, it's not something that we want to pound the table on and say that we can only live with 1/4 of the allocation, because it's more of a comfort level at this point, given that it's a new asset class for the trustees, and there has been historical underperformance of bank loans versus high yield market. Now, we recognize that most of that has occurred during times of falling interest rates, when bank loans should perform better in rising interest rates because of the floating rate nature. But just given more comfort level of the new asset class, potential illiquidity of the asset class, that we feel more comfortable with 1/4 of the high yield allocation than 1/3.
And I guess I'm confused. Are you saying that bank loans are a separate asset class from high yield?
No, I'm saying that they act differently, act similarly, but differently than, they don't move in lockstep to the high yield market.
So we're considering them a portion still of high yield, a subsector.
Yes.
And so you're advocating a 25% allocation to start out. And so Ben, could you talk to us about your recommendation for
Right. As I believe Bud has in his recommendation, this is part art, part science. When we look at what this does to Sharpe ratios, you have a lower expected return for bank loans, as Bud mentioned, but you also have a lower expected volatility. In addition, you have a more secure investment that has a higher recovery rate. Both bank loans and high yield are below investment grade, and both universes, as defined by the indexes, are very, very similar in quality, meaning they're below investment grade, and also this double B, single B, triple C nature of them follow very closely. So our view was that 1/3 is reasonable. Callan's view that their preference was 1/4, I believe in their language they said they would be okay with 1/3, but their preference was 1/4. I don't want to be glib and say we're splitting hairs, but the reason Callan had the 1/4 rather than the 1/3 was because it was a new asset class. We feel ideally 1/3 makes sense, so perhaps Callan is suggesting, I won't put words in your mouth, but Callan is suggesting start with 1/4 and then move up and eventually get to 1/3 if the board's comfortable with that. And we're saying we're comfortable with 1/3 right now.
And what are the rebalancing ranges that you're both recommending around this?
It would be the same rebalancing ranges that exist, but it would be the total rebalancing range for high yield and bank loans, which is presently plus or minus 2%. So right now, the policy for high yield is 4%. So it could be as low as 2 and as high as 6. Because of the adjusted policy, we're at 6 because of the parking places. It could be as low as 4 and as high as 8. As it turns out, we're right on 6. The bank loan piece, because it actually falls, whether it's 1/4 or 1/3, actually falls below, within the rebalancing range, we thought it made sense to have a policy that said up to 1/4, see now you got me saying 1/4, up to 1/3, because even that 1/3 is, by itself, is within the rebalancing range. Meaning, up for 4%, 1.3 is within that rebalancing range. So you could be 0 to 1.3. Bud, any comment on that?
No, I mean, we have no problem with the ranges. It's more of a target.
How much splitting the rate? Between 25 and 33.
Is anyone better at fractions than I am?
How about splitting it between 25 and 33?
29 and a 29 and a sixth.
29. Or have a 25% target with a maximum of 33.
We could do that. That seems like... That's reasonable.
So we could live with 25 and 30.
In other words, yeah.
So just to be clear, we're talking, Allison, 25 to 30, I think you said between 25 and 33, so...
Whatever.
So we would start with 25, and it can go up to 30, it can go up to 1/3, is what that. So therefore, there would be a separate rebalancing that would say that you can't go above a third in bank loans.
If I agree to above 25, we just won't do it.
Right. But we have a ceiling of a third.
Good.
The front thing.
So I have a question with regard to advice that you've provided to other clients. So for another client that's of a plan of this size, you've made a recommendation of investing not more than 40%
Yes.
of the leveraged loan application in niche managers as a risk control strategy. So are you making that same recommendation with regard to this policy?
No, here we're recommending 17.5%. And the short answer, and of course you'll ask why, and the short answer is that system is teachers. Again, I don't know if it's good. Teachers is not NYCERS. Part of the difference is that teachers had a lot more to allocate. For instance, because teachers doesn't have hedge funds, teachers has emerging market debt, there was a bigger parking place. So for instance, your adjusted policy takes you from 4 to 6. Teachers' adjusted policy took them from 4 to 9. So we feel not 6% is a lot of high yield, 9% is a hell of a lot of high yield. And so we felt that we wanted to diversify, we needed to diversify more teachers because we were putting out a lot more than NYCERS is on an absolute dollar amount. Whereas NYCERS, we wanted to make sure that you had more core representation in the portfolio.
So you're recommending that the policy statement say up to 17.5% in niche managers?
We recommend that the managers, we don't recommend 17.5% as niche managers. We recommend these are the managers and we're comfortable with approximately, there's no magic number of 17.5 or 20 or 25. We'd probably be comfortable with anywhere in that range. But we were comfortable after talking with Talon with this recommendation. So let me back up to describe niche managers without, because we're in a public session, describing the specific managers. When we did high yield, we came up with categories of defensive managers, aggressive managers, and core managers. When we did the bank loan search, we came up with a different set of categories. It appeared that managers were either core, and most of them had a value tilt, or they were niche managers. The niche manager that we're recommending, what makes them niche is that they have a focus instead of the large liquid is relative. Instead of the large names in the index, they have a focus on the smaller middle market names, which means they have less liquidity. So we felt that for NYCERS, given the dollar amounts that they have, we were comfortable with the niche managers having the 17.5% and the 82.5 being in core managers, meaning they would have slightly more liquidity. Having said that, when we looked at the data and looked at the volatility and looked at the liquidity, it was interesting to find out that there was less volatility with the particular niche manager that we're recommending, and we can talk about that in the executive session, and the charts that we have in the board package shows that there's actually less volatility. So it's a bit of an anomaly that the manager has been very successful in selecting middle market companies, meaning smaller companies than the larger LBO deals,
that have liquidity, although it's less liquidity, but also less volatility. So they did a good job of selecting managers or investments that had higher returns with less volatility.
So I would be comfortable if we put some sort of limit in our investment policy to niche managers, because it is prudent for us to have risk controls in our policy.
And we are recommending hopefully my math is right here, 82.5% and 17.5%.
So could we have a 20% risk control?
Up to 20, 80, 20?
20%.
That? Right, and again, the difference between the other system was simply they had so much more dollars to put out because of the different partner classes.
And then Martin, I'm confused because we have a high-yield investment policy statement already in our larger investment policy. And since you're advocating that leveraged loans, or bank loans as we call them, are just a subsector of high yield, to me it's confusing to have what looks like a standalone investment policy statement for bank loans.
Right.
I'm curious as to why, if I look at our Core Plus 5 policy, for example, I see various subsectors, like credit, under Core Plus 5. So what I was expecting to see for this investment policy was just to have bank loans as a subsector of high yield. I'm confused as to why it's being now provided. We don't have a standalone policy for credit. It's a subsector. Why isn't merely a subsector of the high yield investment policy?
This was a significant discussion internally with us and our consultants. And I don't know what section it is in the IPS, but if high yield is section 5 in the IPS, does that make this section 6 or does this make it section 5A? We felt ultimately that there were important enough differences in leveraged loans that while the overall policy would be that it would be up to a third, and Callan said up to a quarter in leveraged loans, but because of the characteristics as we described last month of the fact that we noted here that leveraged loans are floating rate obligations and they have very little duration, the characteristics were different enough that it warranted a separate section in the investment policy statement, but the asset allocation would combine the two for a total.
And I guess another source of my confusion, and I've discussed all of this with Martin, by the way, is that this is a private asset class or sub-asset class. And we have recently actually produced some new investment policy statements for our private asset classes that have more robust risk disclosures, just discussion of implementation, investment guidelines, etc. And I have provided comments that we would like to see a very similar statement, have those sections incorporated into this proposed leveraged loan policy, and I'm disappointed to see that my comments were not included. And I think our process has been to date, when there is an investment policy statement that's provided to the board, that the policy statement is circulated, all of the board members are given the ability to make comments, and a red line is provided to the board, and I don't see that happening in this case. So I'd actually like to ask that we give all of the board members time to make comments and provide red lines for consideration to the policy, and table this until we've all had the opportunity to do so.
So I'd like to explain why our feeling that this version was the appropriate version versus the version that we use, say, for opportunistic fixed income, or that we use for hedge funds, or that we use for private equity. You mentioned private asset classes. We felt it was really alternative asset classes and not private asset classes, meaning the asset classes that would have While technically, you're right, these securities trade over the counter and they can be considered private, but so is high yield, and so is, quite frankly, most of all fixed income. And so we were distinguishing the newer version that was adopted to be for the alternative asset classes, not for the traditional asset classes, and we would categorize bank loan more into the traditional asset class. We haven't invested there in the past, but we would categorize it more in the traditional asset class, just like we would as we would high yield.
And Bud, is that correct? The bank loans are pretty much a traditional asset class today, or mainstream for all your other clients?
Yes. In our opinion, they act very similar to high yield, and so when we set them up in investment policy statements, they usually are in the marketable securities area.
Well, I guess I'm still going to just reflect for the record my disappointment that my comments were not incorporated into the investment policy. And I'd actually like to make a motion to table a vote on the policy until... Sure.
Your comments, did you share them with the other trustees?
Well, I shared them with BAM, and what my expectation was is that they would be then redlined and would come out to all the other trustees like has happened in the past when we've provided comments to BAM. They've circulated the comments to the trustees and the board, and everybody has had the opportunity to review them. So I'm just disappointed that that hasn't happened.
No, I need to cut you off. I apologize if I did. I need to cut you off. I apologize if I did. I would just say that in terms of the practice that Janet, I apologize, was referring to, I think that was when we sort of did wholesale changes to the IPS, and as this was an addendum, we discussed those comments, discussed those with the consultants, we discussed those with our own staff, so I think we tried to reflect the document that was consistent in terms of it being more in the public markets area. We're comfortable with it. To us, it's a board decision if they want to have us review it, but we're comfortable with it for the reasons that Martin and myself have stated.
So that's why I'm making a motion to lay this particular decision on the table until we've had time to provide all of our comments to BAM and circulate them to the rest of the board. Give everybody the ability to make additional comments to the policy. Do we have a second?
I would second that.
You don't need a motion to table something, you could just request to table.
Okay. Thank you.
But I have a related question for Bud. But is it your experience that your clients make investments in asset classes before they've completely agreed to the IPS with respect to that asset class?
No, it's typical that the IPS is in place and then you make an investment.
So I'm actually comfortable moving forward with the investment. It's really just the solidification of
The style of
the IPS. So I'm actually comfortable.
Well, I mean, that's going to happen in that executive session.
Correct. So do we have a motion to move into executive session?
No.
Do we have a second? All in favor? Any opposed? Okay, so...
Well, I want to say for the record that...
Wait for a second. I've
stated this in the report before.